in order to make good decisions about your work and your retirement. We have a lot of people entering the meeting right now, so I'm going to ask for a little grace while I take a few minutes and admit them. Cheryl, could you call Patrick and let him know that we have started?
Phone number. I don't think, but I'll try.
All right, thank you. All right, we're going to get started this morning, and we are going to get started this morning with one of our guests who always adds a tremendous amount to our pre-retirement seminar because she brings critical information for us. And today she's going to share some really good news. And Sharon, we are recording this, and you will get the link to the recording. I'd like to introduce from the Social Security Administration, Ms. Anise Norman, who is going to share with us everything we need to know about Social Security, including some exciting news.
Well, thank you so much, and good morning, everyone. I'm going to kind of do a little something different than what I would normally do because we know that because of President Biden, or I should say former President Biden, on January 5th, he signed the Social Security Fairness Act, which now eliminates the windfall elimination provision and government pension offset. So, one of the first things I want you to know is where you can find this information on our website. So, let me see if I can't share my screen.
We fixed that for you. I'm sorry.
Okay, that's okay. But where you're going to go as we get me permissions to share my screen is you're going to go to our website at socialsecurity.gov or www.ssa.gov. And once you go there on the main page, you should be able to see. Let's see, I see everything, but give me just 1 second here. There we go. We
Should be able
should
to
be able
share
to
now.
see. There we go. Are you able to see that on my screen or no? Is it
Yes.
sharing?
Yes.
Okay, so on the screen here, you're going to be able to see at the top because you see in yellow the employers they should use the Social Security Business online services. But right below that it says information about Social Security Fairness Act WEP GPO. Here is where you're going to click because our agency has dedicated a whole page to all of this information. So this is where you're going to come to get a lot of your frequently asked questions or FAQs asked here. It says that the page was most recently updated as of yesterday. What it talks about is who does it affect? And of course, we know it affects any individual who was going to receive compensation or a pension from an employer who did not pay into Social Security. And that's going to be individuals like firefighters, policemen, teachers, anyone who worked for the federal government and they fall under the civil service retirement system, or even if you worked overseas or for a foreign government and you're getting a pension from them. This is who it's going to be for, all of these individuals. And what it says is now that the Social Security, it will no longer be reduced. The main thing I want to tell everybody about this is that number one, the first thing that you can do is to ensure that if you have a My Social Security account, please log in. Please, please, please make sure your address and your telephone number it is up to date and current because as changes do come about, you will get those notices be sent to you in the mail, or they're going to be in your My Social Security repository. The other thing that you need to make sure that you have correct is your direct deposit information, especially those informations, excuse me, especially those individuals who have been receiving Social Security benefits for a while now. Then we would be able to send your retro or past due benefits, because also one of the things that it is saying here in this provision of the law is that the first month that where this new provision of the law will be applicable to individuals will be starting in January of 2024. So if you are receiving benefits from January 2024, we're going to go back to that point to correct your record and then make sure that you're paid correctly going forward. So we'll go back retroactively starting from January of 2024 up to the present for anybody who's already receiving benefits. New individuals, if you have not filed yet, but you're getting ready to file, when you contact Social Security, you can either file online, the easiest way to file, or if you're contacting our national 800 number or calling the local office, once we've identified you as someone who could have been subject to the windfall elimination provision, starting on Friday, the agency has set up a specialized unit that when we connect you with this unit, if you are prepared to proceed, we can go ahead and take that claim immediately for you. But I'm going to ask that, as Tony said, you give us grace, because as we're going through this, one of the things I like to make people aware of is that our agency is at a all-time staffing low. We have the lowest number of employees working in the agency in the last 50 years. The other thing is that President Trump, on day one, he did sign a hiring freeze. So as of right now, the agency is not able to bring on new individuals to process this workload. The other thing that happened also is we have this new workload, but the agency was not given additional funding. So we're just asking that you be patient with us with this. The other crucial thing I want to highlight for any individual who may have been affected by windfall elimination provision or government pension offset is concerning your Medicare. If you are having to pay your Medicare premiums out of your own pocket because there wasn't enough money left over to pay those Medicare premiums, I need you to continue to pay those Medicare premiums until you get a letter or a notice in the mail from Social Security. You got to continue to pay those up until the point that we're able to get our systems animated or updated in a way that then we can see, okay, this is what this person should have got with Social Security. Now we need to deduct those Medicare premiums out of it, and this is what this is owed to the person as their monthly benefit. And even if you paid your Medicare premiums in advance, we will look at your record, and if you have overpaid, we will refund that money back to you, but it is going to take a little bit of time. So we're asking everybody to please be patient with us with this. Also, some other good questions on there. It talks about, will every firefighter or teacher, receive a benefit? And then it talks about the average that what somebody would receive here, how much somebody's pension amount may increase also. And then it also talks about, like I just talked about, individuals who are already affected by the windfall elimination provision. This is going to be your resource here. So once you come to our webpage, please go here first, make it pin it as something as a favorite for yourself so that you can have access to this information. And of course, as everything is being updated, we will let individuals know. The agency is working on making sure that, all of the states are aware of this information by sending it to the different organizations that we work with. Like myself, I've already notified Miss Tony when it happened. I also sent some information out to a couple of different cities that don't pay into Social Security, letting them know, boom, this is going to affect your people, so that they would be aware of it as soon as possible. I think I have one city that I sent something to her, and the lady's like, oh, you can just talk about it when you come out in such and such, which was going to be 8 months away. And I'm like, no, ma'am, you need to know about this now, because this affects your people right now so that they can make appropriate decisions. So we are trying to get the word out as best we can on that. And with this, I'm going to go ahead and jump straight into my presentation. And of course, I will be checking to see if there are any questions for me about this. And I will just remind everybody, this is where we want to come back to with this information. So now let's go to the presentation. And one of the things I always tell people about Social Security is number one, it was never designed to replace your pre-retirement income. It is only going to replace approximately 40%. Can everybody see the Social Security 101 retirement screen? The first page of the PowerPoint?
We see your notes.
You see my notes. Okay. So it did not take. Let me stop this again. It goes and then it comes back because on my screen it looks like I'm sharing it properly.
Right.
So we're going to do this again. Share. Then we're going to come here and we're going to go.
Okay, now click the little screen at the bottom down there.
I did, but I don't think it likes it. Hold on. Let me just try this one more time. But we're going to get through this and I'm not going to take too much of your time here.
Well, we can certainly look at it in that view.
Can you see this one?
There we are.
Okay, perfect. Okay, so here we go. One of the things I always tell people is that Social Security, it was never designed to replace your pre-retirement income. It is only going to replace approximately 40%. So that means that if you know that 40% of your retirement income is going to come from Social Security, think about your other sources, such as, are you going to have VA compensation? Are you going to get a pension, annuity, or from another source? Do you have an IRA, or do you have money in the savings account? And the question that you need to ask yourself is, will it be enough to sustain me in retirement? Because most financial planners are going to tell you you're going to need somewhere between 70 to 80% of that pre-retirement income to live comfortably in retirement. So I'm hoping that by the end of this presentation, you'll have a better idea of how we come up with or calculate that Social Security benefit for everyone. One of the new things that we're doing now is that if you ever need a replacement Social Security card, now all offices across the nation are appointment only. So instead of walking into the office not knowing when you're going to be seen, it is best that you contact the office so you can have a set date and time for us to contact you either by telephone or if you are coming into the office so that we know that you will be there face to face with us. For the My Social Security card, where you want to go is visit our website at socialsecurity.gov. Look for the Social Security card online application. You're going to complete that application for us. Then at the end of the application, it will ask you the question, do you want an appointment in the local servicing office? Of course, you're going to say yes, and then that will bring up your local servicing office's appointments, what's available, and then you can look at your schedule and figure out what works best for you so that way we can get you in and out of the office without a delay. Of course, you can always scan on that QR code that's on the screen, and that's going to take you directly to that application to complete that. And I will send Miss Tony a copy of my PowerPoint presentation after today's message so that you can have that for your own records. Okay, so when you're thinking about retirement, what do you need to know? It's personal. The right time for you to start taking your benefit, that is going to vary from person to person. The earliest that you can start to take a benefit with Social Security is going to be at age 62. Just keep in mind that if you do elect to take that benefit early at age 62, that is a permanent reduction on the benefit. And then the only potential increases you're going to see are those COLA or cost of living increases that are going to be determined by the Bureau of Labor and Statistics. That's usually done late September, October timeframe, where that agency looks at the last 3 quarters of inflation to determine has it risen enough that would warrant an increase in benefits. If the answer is yes, then you see your new payment amount in the check that you would get in January of the following year. Now, I said the earliest you can start your benefit is at age 62, or you may want to wait until your full retirement age. Currently, the full retirement age is 67 for most individuals, but of course, it's going to be based upon your year of birth. But anybody who was born in 1960 or after, their full retirement age right now is 67. Of course, then you may be that individual who wants to max out their benefit by delaying taking that benefit all the way up until age 70. So again, the earliest you can take your benefit is at 62. The latest you can take it is up to age 70. Again, it is a personal preference depending on what is going on in your life, because only you can make that determination based upon your financial situation, what your health care may look like, things of that sort. That will determine what will be the right time for you to take your benefit. Another thing to think about today is Medicare. We tell people Medicare is not mandatory. However, if you do not enroll in Medicare at the first opportunity that you could have enrolled, just be aware you may be subject to a 10% penalty for every 12 months that you wait or delay in taking Medicare, and that is a permanent penalty on top of whatever the base premium would be for that. So just make sure that you are enrolling timely. And I can tell you that the state of Georgia, especially with that state health benefits, they're normally going to notify you. I believe it's going to be what is it, 4 months and 2 months? Okay, 4 and 2 months right before it is time for you to enroll in Medicare to ensure that you are enrolling timely. Because if you don't, you need to be aware that if you don't enroll in Medicare like you are supposed to, that great discount that you get on your premiums, you will lose that until such time that you do get enrolled in Medicare. And if you miss your enrollment period with Social Security, you may be waiting all the way around until the next general enrollment period. So please make sure that you take action on these items in a timely manner for yourself. And of course, today I'm going to highlight the My Social Security account for you. Again, if you haven't already created one, please go and visit our webpage at socialsecurity.gov to log into your My Social Security account. Now, the way that you have to get into it is by using either login.gov or ID Me, because both of those entities have been vetted by Social Security to be secure way for you to be able to log in and then to access this Social Security information. And the Social Security, the My Social Security account is a secure suite of services that you're going to have behind our My Social Security, behind the Social Security firewall, where you're going to be able to do certain transactions for yourself. It's kind of like self-help items that you can do for yourself. One of the things, as I mentioned, if you needed that replacement Social Security card, you can now log in through here. So instead of doing the appointment, just log in through your My Social Security account. Give us information from your ID or your driver's license, and we'll process that request for you. Everybody has to have their own account to be able to do that, meaning they have to be age 18 or older. If you have a younger child that you need a replacement card for, you would need to make the appointment for them. Other things that you can do behind the portal is, of course, you're going to be able to update your address, telephone number, start or change direct deposit information. If you need to review letters that you're going to be getting from Social Security, make sure that you come here. If you've misplaced that hard copy of the letter, it will be in your repository here. Now, since we're coming up on the tax season, if you needed a replacement 1099 or 1042 for tax purposes, you can request that here as well. And also, if you ever need a replacement Medicare card, you can get that here. One of the things I normally tell people to do here is to log in and to look at your earnings record at least once a year. When you're looking at your earnings record through your My Social Security account, be sure to expand it out so you see your full earnings record, starting with the first year that you ever had earnings up into the last year. So what you would probably see right now, we're probably seeing 2023, because normally 2024 is not going to be posted until the end of the third quarter. So probably until like close to the end of March is when you start to see those 2024 earnings. What you're going to look to see is, are my earnings correct? You're going to click on the year and it will show you what earnings were reported to Social Security for that year. If you notice that there is a discrepancy, there is a way for you to upload either a W-2 or a tax return. When you send that to us, we're going to get an alert to go back and look at those earnings and to make sure that they're correct. If we need to adjust them, we will, because it may make a difference when we go to calculate how much are you going to get from Social Security. Other things that you can do behind the portal is if you ever need to apply for retirement, Medicare, file an appeal, file for disability. You can do all of that through the My Social Security account. But the great thing about utilizing your My Social Security account is that you're going to be able to track the status of your application. It will show you a percentage completed. And then when, of course, your case gets 100% completed, then at that point, you would be able to see that notice or the letter regarding the decision on your claim there for yourself. So that's going to be just a few things that you can do behind the portal. So let's talk about, how do you qualify for a benefit from Social Security? Of course, we all know that we have to work, meaning you had to have paid into Social Security by paying those Social Security or FICA taxes at some point over your working lifetime. So for 2025, each $1,810 in earnings, that gives you 1/4 of coverage. You can earn a maximum of 4/4 of coverage per year. So in 2025, as long as you have grossed at least $7,240, you earn your 4/4 of coverage. At the end of the year, that's when those are going to be credited to your account. The minimum requirement to get something from Social Security is that you have to have 40/4 of coverage over your lifetime. So at a bare minimum, you had to have worked paying into Social Security at least 10 years. And once you've done that, then you would get something from Social Security. Now, the way that we determine what that something is that we're going to look at your earnings record, and then we're going to adjust those wages for changes in wage levels over time. Because if we weighed them differently, say in 1970s using a different formula, then we'll use for whatever year, we're going to use the appropriate formula to weigh those earnings. What I tell people, the most important piece that you need to understand, that is the second step here. This is where we're going to look at your highest 35 years of earnings over your working lifetime. That's what we pull into the calculation. And of course, if you're that individual who only did bare minimum, you only worked 10 years working, paying into Social Security, we pull in those 10 years of actual earnings, but attached to that is 25 zeros, because the formula is always based upon your highest 35 years of earnings over your lifetime. And of course, the more zero years you have in the formula, the lower that estimated Social Security benefit would be. The result of that is the average index monthly earnings, which equates out to how much are you going to get from Social Security. Earlier, I stated that you can start your benefit as young as age 62, or you may want to wait until your full retirement age. Your full retirement age is based upon your year of birth. So take a moment to find on the screen your year of birth. The next column, or the middle column, shows what your full retirement age is. The last column here shows with an example here that if your benefit at your full retirement age was $1,000 at your full retirement age, but if you chose to take that benefit early, say at age 62, it shows how much your benefit would be reduced by. Someone like myself, I fall in the category of being born in 1960 or later, so my full retirement age is 67. If I choose to take my benefit at 62, then I'm looking at receiving 70% of the benefit starting at age 62. So in this example, instead of me getting $1,000 a month, I would be looking at receiving $700 a month, and that's before any reductions. Let me just say that, because I'm choosing to take this benefit early. This example here shows that if a person's full retirement age is 67, and if they wait until age 67, in this example, we're going to use $2,000 a month. But let's suppose that this individual decides to take their benefit early, say at age 62. Well, instead of them getting the $2,000 a month, they're going to be receiving $1,400, because remember, because they're taking it early, there's a 30% reduction. So they're looking at getting $1,400 a month. But let's just suppose that individual whose full retirement age is 67, when they reach their full retirement age, for whatever reason, they're not ready to start taking their Social Security benefit at age 67. Maybe they're still working somewhere, or they have enough income that they're wanting to max out that Social Security benefit. If that's the case, anytime you wait past your full retirement age, you earn what we call our delayed retirement credits. This means that you can earn up to 8% for every 12 months that you wait or delay in taking this benefit, all the way up until age 70. Age 70, that's just the point where Congress said we're going to stop the calculation for you. And just remember that if you wait past age 70, we can only go back 6 months retroactively to pay you a benefit. So please just make sure that you're filing for your benefits timely, so that way you won't be potentially missing out on any benefits here for yourself. The other thing that I wanted to show, that if you did wait until age 70 in this example, then instead of getting $2,000 a month, you're looking at receiving $2,480 per month. That is the gross amount of the benefit. Social Security, we do not withhold taxes from your benefit unless you ask us to do so. And if that is the case, we at Social Security will only withhold federal taxes only from your benefit. But again, you have to initiate that conversation saying, I need you to withhold federal taxes from my Social Security benefit. And if so, then we're going to give you 4 options as to which one you want us to do. And then we'll let you know how much that would be withheld from your benefit. So just be aware of that. In addition to you, who else can get a benefit from your record? Well, of course, your child, as long as he or she is age 18 or 19 and still in high school, or if you have a child that has a disability, and as long as we at Social Security are able to determine that your child's disability began before the age of 22 and this child is not married, then they could be eligible for what we call is a disabled adult child or a DAC benefit off of your record. In addition to your child, your spouse may be eligible to draw benefit off of your record as long as he or she is age 62 or older with little or no work history, that you guys have been married for at least a year or longer, or you may be eligible for a benefit at any age as long as you are caring for a child that is under the age of 16 or disabled. Now, how the spousal benefit would potentially work for someone who may be eligible to receive a spousal benefit is that you may be eligible to receive up to half of your spouse's benefit. But in order for you to get that, we at Social Security have to look at your age. You have to be at your full retirement age in order to potentially be eligible for this. If you try to apply for a spousal benefit and if you're younger than your full retirement age, then of course there will be a reduction in the benefit. If you take it at age 62, then you're looking at receiving approximately 30% of your spouse's benefit. Now, how this works, in order for you to be eligible for the spousal benefit, meaning number one, that your spouse, he or she has to be receiving his or her benefit, meaning that they have filed the application for their retirement benefit and they have started to receive that benefit from us. Once that happens, then that opens up the window of opportunity for you to come in and say, I want to file for a spousal benefit. When you do, the first thing we at Social Security, we're going to look to see, did you work enough to receive a benefit off of your own Social Security number? If the answer to that is yes, we look to see how much is it, and then we look to see at what age are you going to apply for your benefit. And if your amount is less than half of your spouse's, we can get you up to half of their benefit by taking whatever you're going to get off of your record and adding from their record up until you get to up to half of their benefit. But remember, you have to be at your full retirement age to get the maximum spousal benefit, which is half of whatever their benefit would be at their full retirement age. And this does not include those delayed retirement credits. Just remember that. And also, there's a common misconception that a lot of people thought that I can't take the spousal benefit because if I do, it will reduce what my husband or wife is going to get. That's not true. The spousal benefit does not reduce whatever benefit they would receive. So if their benefit is, say, $2,000 a month and they've waited until their full retirement age to apply for that benefit, that is what they're going to get. They're going to get that $2,000 a month. That would mean that the most that you could draw off of their record is half of that, which would be up to $1,000. And then we look to see how much do you get off of your own record. Because if, for example, your own benefit was $800, that's more than half of his amount. So you wouldn't get that off of that because your amount is not going to, hold on, let me go back. I think I said that the wrong way. I'm thinking wrong. Hold on. If your amount was $800 and half of that is $1,000, what you would get is $200 from his record to get you up to $1,000 because the $1,000 is the most that you would get off of his record. So excuse me if I misspoke there, not trying to confuse anyone. But just remember, if your benefit is less than half of theirs, the most that you could get is up to half of their benefit. But again, you have to be at your full retirement age. And if you take your benefit early and applying for a spousal benefit, then the reduction would apply. For those of you who are married, again, we're going to look at that formula here to find out what somebody's full retirement age is here. So find your spouse's full retirement age. The next column shows what their full retirement age is. Going back to the first example, that if your benefit is $1,000 a month, the most that your spouse could draw off of your record is up to half of that, which is 500. Again, the third and fourth column here shows that if either one of you take your benefit early, it shows how much the benefit would be reduced by. Now, if you are divorced from someone, you may qualify for a divorced spouse's benefit from their record. The minimum requirements is that you had to have been married to this person for 10 years of marriage, and that is 10 consecutive years of marriage. You are currently not married. You are age 62 or older. And in this scenario, the person, your ex, all he or she needs to be is eligible to receive either a retirement benefit, or they're potentially eligible to receive a disability benefit. If that is the case, what we're going to do again is we're going to look to see what can you get off of your own record first. If your amount is less than half of theirs, we can combine the two amounts to get you up to half of that person's benefit. But again, you must be at your full retirement age in order to be able to be eligible to get up to the 50% or half of that benefit. Also, what I want to highlight is that when we're talking about you receiving a spousal benefit, either as being currently married to someone or divorced from someone, the spousal benefit means that that person is alive and well. The most that you can ever get from that person's record when they are alive is up to half of their benefit. And I'll talk about potential benefits when someone passes away here. Now, in this first example here I have for you, we have Ricky and Lucy. In this example, Ricky, he's receiving $1,200 a month. Half of that is $600 a month. His wife, Lucy, she decides that she wants to file for a spousal benefit. So she contacts Social Security. We look at her record and we determine that off of her own record, she's eligible to receive $1,000 a month. So when we do the comparison, $1,000 off of her own record or $600 off of Ricky's, we determine that Lucy is not going to qualify for a spousal benefit in this scenario because she can get more money off of her own Social Security record. And you're only going to get the higher of the two. You do not get both, the higher of the two. Now, in the second example here, we have with Luke and Laura here. In this example, Laura, she contacts Social Security and files for benefits, and she's receiving $1,800 a month. Half of that is $900. Her husband, Luke, he's been receiving benefits for a while now. And because Laura filed her application and has started to receive her benefit of $1,800 a month, this now opens up the window for Luke to now receive an additional $300 from Laura's record. So 6 plus 3, that's $900. That's going to get him up to half of her benefit amount. Also keep in mind that if Luke and Laura have any eligible children, they also would be able to receive a benefit from Laura's record as well. Now, if for any reason Laura were to decide to suspend or stop receiving that Social Security benefit, that extra $300 that Luke is getting, that will stop for her. Also, this would stop for the children as well. The exception to this will be the divorced spouse. The divorced spouse, they would still be able to continue to receive their benefit. Now I'm going to transition and talk here for a moment about what happens when your spouse passes away, what potential benefits are available for you. So first of all, we're going to look to see who's eligible for it. So starting with your child, as long as he or she is age 18 or 19 and still in high school, or if you have a disabled child, and as long as that disability began before the age of 22 and they are not married, then they're going to be eligible for that disabled adult child or that DAC benefit from Social Security. Then you have the widow, the widower, or the divorced widow or widower. So they could start to receive reduced benefits as young as age 60, or they may elect to wait until their full retirement age to apply for the survivor's benefit, or they may elect to take a benefit at any age as long as they are caring for a child that is under the age of 16 or disabled. Then the last bullet here talks about divorced widows and widowers may qualify. But remember, you must meet the divorced spouse's criteria. You had to have been married to that person for 10 years or longer, currently not married, and age 62 or older in order to qualify for a survivor's benefit. So when we're talking about the survivor's benefit, if somebody elects to start to take this at age 60, they're looking at receiving approximately 71.5% of the deceased worker's amount. If someone takes this option, then when he or she attains the age of 62, we at Social Security, we're going to come back and look and see what can this person get off of their own record at 62. Is it more money? If the answer is yes, then we're going to switch you to your own record. Now, if you wait until age 62 to apply for a survivor's benefit, you're looking at receiving 82.5% of the deceased worker's amount. Or you may elect to wait until your full retirement age. If you take this option, then you're going to receive 100% of the deceased worker's amount. Also, this allows you the opportunity to leave your own benefit alone. Let it continue to grow up until age 70. At age 70, we come back and take another look to see, can you get more money off of your own record? If that is the case, we switch you to the higher record. And then this last bullet here talks about full benefits are available to the widow, the widower, and the divorced widow or widower. All we're saying here is that if the person who is deceased, if they passed away and they had a current spouse, as long as they have been married to that person for a year or longer, that person is eligible for a survivor's benefit. And if they were divorced from someone who meets the divorced spouse's criteria, that person as well can be able to receive a survivor's benefit. So, in essence, both a current and a former spouse would be able to receive a benefit off of the record, because what we would have to determine is how much money is available for the family there to see what anyone would be able to receive. One of the common questions we get when people start to receive Social Security is everybody always wants to know, can I go back to work and receive my benefit? The short answer is yes, you can, but you need to know, what are you up against? So for 2025, if you are under your full retirement age and you have started to receive your Social Security retirement benefit from us and you're going back to work, the limit for this year is $23,400 for the year. Breaking that down to a monthly amount, that is $1,950 per month. As long as you don't go over, you are good to go. But if you do, what will happen is you are going to get a letter in the mail from Social Security, and we're going to tell you that we paid you too much money. Then we're going to have our handout telling you to pay us back $1 for every two that you went over. Now, in the year where you're going to reach your full retirement age, that goes up. So for 2025, that's going to be $62,160 for the year, or breaking that down to a monthly amount, that's going to be $5,180 per month. This time, if you go over, you would be required to pay us back $1 for every three that you went over. So let's just suppose that this year I'm going to reach my full retirement age. I've started receiving my Social Security benefit and I am working. So, and I'm going to reach my full retirement age in August. So from January 1st through July 31st, I can work and earn up to the $62,160 for the year. As long as I don't go over, I'm good to go. If I do, I got to pay back to Social Security $1 for every three that I went over. Now, when August comes around, even though my birthday is later in the month, but when August 1st comes around, at that point, there is no limit to how much I can work and earn. We tell people all the time, you can make $1 million Social Security. We don't care. However, I do want to caution you to make sure that you are talking to your financial planner or your advisor, because IRS is going to care, because they're going to have their hand out, because then they're going to be wanting their taxes out of that. They're going to be wanting their piece of the pie from you. So just make sure that in anything that you do, especially transitioning into that retirement phase of your life, make sure that you're talking to your accountant, your tax preparer, your financial planner, so that if you do something, you need to know the implication of how is it going to affect you down the road, such as if you say, hypothetically, you win the lottery this year, and you're thinking, oh, that's great. But you have to remember, 2 years down the road, Irma is going to come back into play, and we're going to look back at those earnings, and it may make your Medicare premiums go up for at least 12 months, depending on what your income is in the future. So just be aware of all of that. I had somebody one time, he cashed in a large sum of savings bonds at one time, not thinking how it was going to affect him. And by the time he did it, it was too late, and he had to pay that additional surcharge for at least a year until his income went back down 2 years down the road. So just be aware of that. The things I like to highlight with regards to the limits that you see on the screen, when I'm talking about these earnings limits, I am only talking about you going back to work, working for an employer who's going to be deducting FICA or Social Security taxes out of your pay, or if you elect to be self-employed and you are paying your self-employment taxes. These numbers do not include, I repeat, it does not include your pension, annuities, 401k, rental income, any other type of income. That is not what this is about. Only if you elect to go back to work. The other thing that people always will ask with regards to this is usually something to the gist of, I started my Social Security, say around 62. I decided to get a part-time job somewhere because I wanted to stay active and to stay busy. They always want to know what happens to these new earnings. Well, if you do work somewhere, once you reach your full retirement age, what we at Social Security are going to do is we're going to go back and do what we call is a recalculation or a recomp. Because remember, how much you get from Social Security is based upon your highest 35 years of earnings over your lifetime. If these new earnings do make a difference in that computation, then what will happen is we're going to send you a letter in the mail that'll say something to the gist of, this is what we paid you. This is what we should have paid you. We send you the difference in the money, and then you're going to have a new monthly benefit amount. So we will go back and recalculate it. We only do it once you've passed your full retirement age. And let me just say, it does not happen exactly at that moment, but a little bit down the road is where we go back and recalculate that benefit for you. Another common question that we get at Social Security is people always want to know, is my benefit taxable? Our response is it depends. And in order for us to determine whether or not your Social Security benefit will be taxed, you have to take your adjusted gross income from your tax return. Any non-taxable interest that you may have, you're going to add it to that. Then whatever you're receiving in Social Security benefits, cut it in half. Add all of that together. That is your combined income. Once you have your combined income, then we have to figure out, how are you filing your taxes? Are you filing as an individual or a member of a couple? If you are an individual and if that combined income is less than $25,000, you do not pay taxes on the Social Security benefit. If for an individual, your combined income is between $25,000 to $34,000, you could pay taxes on up to 50% of the benefit. And if for an individual, your combined income is more than $34,000, then you could be subject to paying taxes on up to 85% of the Social Security benefit. And that is not a Social Security regulation. That is an IRS regulation. We at Social Security like to make people aware of that so that there are no surprises. So again, you can plan for this. For additional information with regards to Social Security and taxation, you may want to visit irs.gov, and you're going to go to their website and look for publication number 554, which is the tax guide for seniors. So just make sure you're looking at that and also asking the right individuals. So again, there are no surprises for you. When it is time to file for your benefits with Social Security, the earliest that you can contact us, the earliest to start the process is 3 months in advance. So 3 months before you are ready for that cash benefit from Social Security, 3 months before you are ready to enroll in Medicare, that is the earliest that you can contact us, 3 months in advance. The easiest way to file is, of course, online through your My Social Security account. And always you have the option of calling either our national 800 number at 800-772-1213, or the local Social Security office so we can help you to schedule that appointment with us so that way we can go ahead and take that application for you. And again, I just want to highlight, especially for individuals who may be receiving compensation from the school system that does not pay into Social Security, when you call either the local office or the national 800 number, once we've identified you as that individual, if you are ready, we may be sending you directly over to an immediate claims taking unit. So if you're ready to proceed, we'll get somebody to start that process for you. So just be aware. This is normally where I tell people that if you haven't listened to anything that I've said thus far, you always want to know, when am I going to get my money from Social Security? So let's just take a look here. One of the first things that you need to be aware is that Social Security, we do not pay for partial months. You have to be that age throughout the whole month. If your birthday falls on the first or second day of a month, we give you credit for that month. If your birthday falls later in the month, then we have to look at the first potential month is the next month. The next thing we need to understand is that benefits are going to be paid the month following the month that they're due. So if you contacted Social Security in this month, January, said you wanted to file for your retirement and you want your benefits to be effective or to start in January, we will say, great. Your first payment will come in February. And then depending on your day of birth, that will determine the Wednesday of the month that you're going to receive your benefits. So if your birthday is the 1st through the 10th, that is the second Wednesday of the month. The 11th through the 20th is the third Wednesday of the month. And the 21st through the 31st is the fourth Wednesday of the month. So you may want to just keep that in the back of your mind to know, when is that Social Security benefit going to hit my bank account as you prepare for retirement. I'm going to take a moment here because I do have a few questions over here that I want to go back and see if I can't try to adjust address a couple of little things here before I go into Medicare. I see Miss Cheryl is saying that my husband's Social Security check went down this year. He and I filed jointly, and we did not make over the 200,000, which the site says for the supplemental Medicare increase. Why would it go up? I'm not sure, because every year, the tax laws and all of that stuff change. What you may want to do, because without looking at your whole situation, because I can only do generalities in this type of presentation, you may want to contact your local servicing Social Security office, because it could be with the new amount of the Medicare premium. And also the other thing to look at is, did your husband ask for a voluntary tax withholding? And if so, how much? Because that may be the difference in the missing money for you to check that out. So you may want to contact your local servicing office to determine how much, why his net went down, by asking us, if this is the gross amount, where's the difference in the money, so that way somebody can be able to tell you or advise you what is happening here. Someone is asking here, Miss Kimberly is asking, will you still receive a yearly COLA by starting early? Yeah, even if you do start your benefit early, say at age 62, like I said, the Bureau of Labor and Statistics every year around late September, October, they determine whether or not inflation has risen that would warrant an increase in benefits. And if so, everybody would see whatever that new percentage would be in their payment amount that they would receive in January of the following year, if there is going to be a COLA increase. Someone is asking, let's see, Pierre Charles is asking, what about for employees? And they're saying they are numerous who choose not to contribute to Social Security payments for their employees. Is this legal to do so? Every employer has the opportunity to decide whether or not they choose to contribute into Social Security, because that's where they do work with us and do the business online services to let us know whether or not they choose to participate or to contribute into Social Security. Is really up to that employer as if, or whether or not they decide to contribute or to pay into Social Security, and that is personal. And that is perfectly legal, what I'm trying to say here. So it's really up to the employer as to whether or not they elect to contribute into Social Security. Let's see. I believe we have, I want to say LaFrance Carpenter. It says that this individual worked for DC public school system for 10 years and they didn't take out Social Security. Is there a way to pay in for those years or am I going to get credit? No, you cannot pay into Social Security for those years where an employer did not elect to pay into it, because remember, you may be eligible for some type of compensation or pension from that school system for that time plan for you. Um, so you need to go back to the District of Columbia to see where you vested into their system to see whether or not you're going to get some type of a pension for them. But there's no way to pay as an individually into Social Security for yourself. You either have to be working for an employer who's going to contribute, or self-employed and paying your self-employment taxes yourself. Miss Sandra is saying that I was told a good strategy to take divorced spouse's benefit at the age of 62 and to delay taking mine until the age of 67. But if I hear you correctly, I cannot take the divorced spouse's benefit until age 67. Let me just back up and say here that in, I want to say, the Bipartisan Budget Act of 2015, 2016, Congress changed the rules. So even if you wanted to take that divorced spouse's benefit at age 62, now the way it works is that we have to look at all potential benefits where you are eligible for, because if you're filing for that divorced spouse's benefit, that's like you filing for your own benefit as well. And we're going to look to see at all records, what record can you get the most money from? And that's the record where you would get the benefit from, because in the past there used to be a file and suspend or delay taking your own. You don't get that option anymore because of the Bipartisan Budget Act of 2015. That was one of the changes then. Let's see here. Someone is asking, what is the current death benefit for a spouse? Miss Patricia, it's really going to depend on at what age do you take the benefit, because for a survivor's benefit, you can elect to take that benefit as young as age 60, or you can wait and delay taking it all the way up until age 70. Anywhere in between that is a personal choice for you as to when you decide to take it. And then depending on the age that you take that benefit, that will determine the percentage of the deceased spouse's benefit amount that you would receive. And if you are past age 62, then when you past age 62, then you can leave yours alone, let it continue to grow. And then if you need to come back because things have changed and then take your benefit, you do have that option to do so. I think I covered all the questions. If I did not, please, as I go into Medicare, now what you're talking about, Miss Patricia, when you're saying you thought that there was a one-time death benefit, there is a one-time lump sum death benefit of $255. And normally you only have a certain time limit to apply for that after that individual has passed away. I don't know the time limit on the top of my head, but normally what happens is when somebody passes away, typically the funeral home will report through the electronic or automated death reporter that the person has passed away. This system then alerts Social Security that this person has passed away. So then we can tell Treasury to stop the benefits, so we do not send any funds that the person is not due into their bank account. But you're talking about the one-time benefit is the $255. That's going to be potentially for any spouse of that person, or possibly any children if they're under the age of 18 or 19 and qualify for that one-time lump sum. And only one person gets the one-time $255 benefit. So one person is paid the $255. Okay, someone is asking here, the windfall does not give benefits to people who did not pay into Social Security. No, correct. Because if you did not pay into Social Security at some point over your working career, because then remember the minimum qualification to get a Social Security benefit is that you have to have 40 quarters of coverage, meaning you worked at least 10 years working, paying into Social Security, then you'd be eligible for a benefit from Social Security off of your own Social Security number. But if somebody did not qualify for a benefit off of their own number, but they're married to somebody, they would be eligible to receive either a spousal or survivor's benefit. Because remember, under the government pension offset, that didn't allow you to even get that at all. So if you are someone, because I have a relative who's a teacher, because after all of this happened, she texted me and I was kind of explaining it to her, and I said, well, since you're getting benefits now, what they're going to do is they're going to go back and correct your record. I said, but at that point you need to make sure that you recontact us so that way you can see if you could possibly get a higher benefit off of your deceased husband's record. So that's another thing to think about for yourself. Uh, Someone is asking, do benefits pay a month behind? No, they pay a month behind. Social Security pays a month behind. So if you applied this month in January and you told us you wanted your benefits to start in January, you do not get January's benefit until February to the next month. So just remember that. And also, there's another thing that comes into play, that in order for a person to get a benefit, they had to have lived throughout that whole month. Because if a person applied for their benefit in January, but if something were to happen and they were to pass away in January, that first month where they were potentially due a benefit, they wouldn't be doing anything because they didn't live throughout the whole month. So just be aware of that. Let's see, Miss Teresa saying that both my parents get Social Security benefits now, and my dad is more than my mom. So you're saying my mom may qualify for additional spousal benefit from my dad's record if she qualifies. Yes, that's what I'm saying. Normally, what happens is that, yeah, okay, good. Because I was going to say this was going to be the last question, Miss Tony, and then I'm going to jump into Medicare. But normally, what happens with that, when we take that retirement application, we're nosy. We're going to get all up in your business. We're going to ask you about who are you currently married to and do you have any prior marriages, because we're trying to establish that duration of marriage to look to see who would possibly qualify for a benefit off of your record to see who qualifies. So what, and more than likely it's probably already been addressed, but just to be sure, have your parents contact their local servicing office so someone can look at his benefit and look at hers and then make the assessment. And also, when we're talking about half of the benefit, we're talking about the gross amount of the benefit before any reductions. Okay. So I hope this helps everybody. And with that being said, I'm going to jump over into Medicare and tell you what Social Security's responsibility is. With this. With Medicare, we only do two things with regards to Medicare. Number one, we're going to take your application. And then number two, if you are enrolled in Medicare and receiving a cash benefit from Social Security, then by law, we are required to deduct the Medicare premium out of your Social Security benefit. So the two things that we do is we take your application and then we're going to take your money with regards to Medicare. That is all Social Security does. We're not allowed to talk about, coverages, the different plans. We're only the agency that takes the application for the Center for Medicare and Medicaid Services here for individuals. Okay, so who can get Medicare? First and foremost, anybody who's age 65 or older, anybody who's been on a disability for 24 months or longer, anybody that has ALS, and of course, anybody who has kidney failure or receives maintenance dialysis or a kidney transplant would qualify for Medicare. With Medicare, there are three different enrollment periods that I just want everybody to be aware of. The first is the initial enrollment period. This is your very first opportunity you ever get to enroll in Medicare. 7-month window. It starts 3 months before you reach age 65, birthday month, and 3 months after that. The next enrollment period that a lot of you may fall into is going to be the special enrollment period. And this is for those individuals who are age 65 or older, and you may still be working, or you may be on your spouse's insurance plan and your spouse is still actively working. If that is the case, when whoever has the health insurance, when they leave employment, you have 8 months to contact Social Security to enroll in Medicare, and we consider that timely enrollment for you. And then, of course, the last enrollment period, this is every single year from January 1st through March 31st. This is the general enrollment period. This is going to be for those individuals, for whatever reason, they did not enroll in the initial enrollment period. They don't qualify for that special enrollment period. Also, this is the time where we're going to look to see when was the first opportunity you could have enrolled, and then we're going to have to assess that 10% penalty for every 12 months that you wait or delay in enrolling in Medicare for individuals. And if you need to find your local servicing Social Security office, go to our webpage at socialsecurity.gov and search for office locator, put in your zip code, and it'll tell you the information for your local servicing office. And I am going to kind of skip over a of items because I just want to make sure that I get through because I see I am running over on my time. The other thing I want to make you aware of with Medicare is that there's a couple of different parts you need to be aware of. Either original Medicare. With original Medicare, this consists of Part A, Part B, and then you can add on either Part D or a supplemental policy for yourself. Part A, as long as you have that 40 quarters of coverage, A doesn't cost you anything. If you have less than 40 quarters of coverage, you could have to pay a monthly premium for Part A. Part B, everybody has to pay for Part B. The base premium for Part B is 185.10, I believe, is what everybody has to pay. Excuse me, 185 is what everybody has to pay for Part B. If you make a lot of money, in addition to the base premium, you have to pay an extra surcharge. So just be aware of that. With Medicare Advantage plans, this is private companies following the rules for the Center for Medicare and Medicare Services. They like to bundle together Part A, Part B, Part D, and then throw in something extra. I'm going to tell you, you have to do your due diligence here to make sure that you are selecting the right plan for yourself. Also, especially with the state health benefits plan, it is a very generous plan for you all. Please do not go outside of that plan without talking to somebody. And I'm sure Miss Tony can attest to this because if you decide to leave that plan and you disenroll, you're never going to get it back. So please, please, please talk to the right people and don't just listen to that insurance agent saying, I can get you a better deal over here, but they may be messing you up down the road long term. Also, the state is also going to remind you that you need to enroll in Medicare timely. They're going to send you those letters 2 months and 4 months before you reach Medicare age to remind you to enroll timely in Medicare. And I think that's going to be some of the basics that you really need to understand about Medicare. So, Miss Tony, I'm going to cut it off here. And of course, you have my contact information if somebody has a real burning question. But I hope this helped. And I know I did spend a lot of time on the front end talking about the Fairness Act. And I thank you all for the opportunity to be here with you today, like always. And I look forward to working with you in the future. And I will email this PowerPoint along with some additional handouts for you.
Thank you so very much. As always, you were so informative and helpful, and you make a very important part of our pre-retirement seminar. People learned a lot, and I know there are lots of questions. Contact your local office. We are now going to hear from our good friend Aaron Warner from NEA Member Benefits, who's going to talk about the wonderful member benefits you have as a member of NEA and GA.
Yes. Good morning. How are you?
Good morning, and you can share your screen.
I can indeed. I'm going to do that. Let's see here. Give me a second to get organized. I lost my chat, but let's see. There we go. Okay, so I am going to put in chat a link for everybody to be able to follow so that you can use this link to log in. When you log into NEA Member Benefits, I'm also going to give you another way to do this, and that is through use of a QR code. So maybe I can get there. Well, for now, we'll use the link that's in chat. So you can use that link, and that's going to take you to signing in to NEA Member Benefits. We know that member benefits is an important part of membership for people. It's not the most important part of someone's benefit, but it's a portion of what you get for being a member with, in this case, GAE retired. And folks want to know how they can save money through different benefits and discounts and the things that are available to them. So I'm going to cover through 3 different categories here. One of them is no cost benefit. Another one is savings and discounts programs. And then the last one is just things that are exclusive to you for being a member through GAE. So the first one that people ask me about is travel. And here's that QR code I was telling you about. So you can take your phone and scan this QR code. And that's going to lead us into, again, travel. And you get, through NEA benefits, you get 500 travel dollars that will help you to lower the cost of whatever it is that you're trying to book with NEA member benefits. So whether that is a hotel, whether that's a cruise or a car, a cruise tour, these 500 travel dollars, they roll over every year, and they help to buy down the cost of whatever it is you're trying to book. So, for instance, you can't buy down to zero. You'll never get to zero, but you can buy down the cost of whatever it is that you're looking at. So again, I'm going to give you another QR code for this that you can scan as well. And so let's just assume that you're going to book a cruise, and the cruise might be $1,000. You might only be able to use $300 of your travel dollars, or $400. The system will tell you when you go through and book how many of your travel dollars are being applied to what you're trying to book. And I always use cruises as an example because there's the most fluff built into the cruise prices, and you're buying down, the lowest you can get to is the wholesale cost of whatever it is you're trying to purchase. So again, you can never go to zero, but you can use a good portion of your travel dollars. The next one is magazine service. So I'm going to show you this link here, neamb.com/get2. And actually, I will put that in chat here. That is the link to be able to get 2 free magazines every year. So there's over 800 different magazines that are available to you, and this will allow you to get 2 free subscriptions every year. All you have to do is use that link that I put in chat there, and that will take you to be able to order those magazines. So moving to savings and discount programs. So we do have the NEA customized cash rewards card. You get a $250 Amazon gift card when you sign up for this. And you get to choose what category that you get 3% cash back in. So there's 6 different categories. There's wholesale clubs, grocery stores, gas. You get to pick what you get 3% back at, and then you always get 2% back at grocery stores, and then 1% on everything else. But this is really a pretty good card, and one that you should check out if you're looking at credit cards. So with shopping and travel are probably the 2 most used categories for NEA benefits. And we use the NEA Discount Marketplace, which is partners with Rakuten. And you get a $10 welcome bonus whenever you come here and you do your first shop. But think of this as a series of links of all the different retailers that you might use. So let's just assume you're going to purchase something from Nike. Nike will have a deal in here. Maybe it's 1% cash back, 2% cash back, or maybe they have like you get $10 back or something. All you want to do is go here first before you do your shop. It's the same exact website that Nike is going to provide you elsewhere. You're just going through here to make your purchases, and then you're going to get a check back every quarter of whatever it is that you've purchased. They call it a big fat check. You get that back every quarter. If you're going to go shop in store, let's say that you're going to use Macy's, you will put your credit card in here, and then when you go into the store, it'll match the transaction up via your credit card, and you'll get cash back for shopping in store as well. Here's a QR code again for you to use to get to the NEA Discount Marketplace. And The next one I'm going to show you is NEA discount tickets. So this is a popular way to be able to purchase tickets. Now, people generally think of like Disney tickets or Universal Studios, but it really is any tickets that you are going to purchase that, I mean, I've seen all the way to rodeos that are available. So it could be movie tickets, could be sporting events, could be comedy show. We actually went last night here in I live in Fort Lauderdale, and we went to the Jerry Seinfeld show. So that was available through NEA discount tickets. So again, here's a QR code for you. And then we have exclusive rates, things that are available to you specifically because you're an NEA member and are not available elsewhere. And they check your membership to make sure that every year that if you're enrolled in one of these plans that that you're a member. Now, if you're a lifetime member, then you're automatically in for life with GAE. So but life insurance is one of the best life insurances that you can get that's available to you. I'm going to again show you a QR code, but use the QR code here to go check out these different life insurance plans. There's hospital and disability plans, there's long-term care, there's life insurance, accidental death and dismemberment insurance. There's all kinds of different insurance that's available to you, life insurance wise, that is probably going to be better than other life insurance plans elsewhere. But again, you need to check it out for yourself to see which one is best. So I actually, this is not quite the end of the presentation. I have one more thing I'll tell you about. And so my past, that I used to work with the NEA auto and home insurance program. We do have a new partner now, and that is Travelers Insurance, that you should check them out to get a quote for your insurance. So I will show you the website here. So this is the actual website, and all of the different things that I was telling you about are available here. So discount marketplace, discount tickets. There are things here that I did not cover. So like auto buying, wireless program. I'm going to let you check some of those things out on your own. But I encourage you to come to the website, use the link that I put in chat, and come here and check out the things that might be of use to you. Pet health insurance is a popular one. So with that, I will see if there are any questions in chat. Where are these QR codes? So the QR codes were just what I had on the screen there. Any of the information that I had, you can use you can get to the link that I put in chat earlier. So I will put a couple more things in chat here again. I want to put the link in chat again, and then I'm also going to put the number to the NEA Member Advocacy Center here. So if you have trouble logging in, sometimes people have multiple accounts, and they can use the 800 number to call and get those accounts rectified. How do we join? I'm going to let Tony cover that one for you, on how you join GAE. She'll cover that for you a little later today. The discount question here, are the travel discounts only applied to the individual, or could it apply to family travel? So if you're booking it, you can apply it to family travel. So yeah, you can apply it to everyone. I already have Travelers. Can I get a discount for being a member? Yes, go on, get yourself a quote online here, and then once you get the quote, you can call your Travelers agent, and they can apply that discount for you. So I don't see any other things in chat. If anybody has questions, I'm happy to answer. But Tony, thank you for having me as always.
Thank you so much, Aaron, for being with us. And um, this just scratches the surface of the many wonderful benefits you have as a member of GAE NEA Retired. Um, and of course, if you're still an active employee, you have these benefits as an active member. I know that I personally have for decades used NEA member benefits for my auto and homeowners insurance and life insurance. Um, I've used it for car rental. Um, I've used it for shopping. Um, it really pays for your membership. It really does. And of course, if you are retired as a lifetime member, these benefits are yours for life. As an active member, they're yours as long as you maintain your membership. How do you join GAE Retired? Before the end of this session, I will put a link to the membership application in the chat. But if you are actively employed as an educator and want to join GAE, it's simply joingae.org. And you can apply online for your membership. And it's a very simple process, and the benefits are great. Not only are the member benefits great, but also the protections you have as an educator are tremendous. Any other questions for Aaron? All right, then. We are now going to move on to what we're going to do is we're going to switch the agenda up a little bit, and we're going to let Cheryl Sarvis tell us how we got to the wonderful news of the passage of the Social Security Fairness Act that Anise talked to us about at the beginning of her presentation. So, Cheryl, if you are ready, the floor is yours. Don't forget to unmute.
Can you hear me?
Yes.
Okay. Well, this is something that we need to celebrate, but it has occurred to me that maybe some of you who are not under the GPO and WEP restrictions don't even know what it is. So just a 60-second brief introduction to what it was. In 1977, the Congress began treating the pensions as those earned by educators as a Social Security benefit. And the effect of this change was a dollar-for-dollar reduction in Security survivor benefits for anyone who was earning a public pension. The WEP was enacted in 1983 to prevent people with relatively high compensated government service and relatively low paying Social Security covered employment from having their Social Security benefits determined under a more favorable formula for retirees. In other words, the government began to say, well, you're going to be getting too much money if you get your government pension. And our pension, teacher retirement, is considered a government pension. It also applies to firefighters, as Anise said, and police officers and others that are getting a pension. Well, to let you know what benefit you now have that you did not have 2 months ago, you are really in for a treat because you don't have to worry about what this was doing to you. NEA and GAE and GAE Retired have been working on this constantly for years. In the early 1980s, I was put on a committee, and to start with, because a lot of people didn't know how this was going to affect them, it was more of an informational piece. Then NEA began to try to get Congress to enact a law that would eliminate the GPO and the WEP, which was hurting our educators. And they continued to do that from then on. At the NEA meetings, we were distributing information. We were getting stories of people who were affected by this. And it was a long, drawn-out process. I must say that I began to doubt that it would ever take place. We went up to Congress and we testified in Congress and lobbied our senators and representatives, trying to get them on board to eliminate the GPO and the WEP. It went in, but we could never get it up to a vote of that committee. And, you know, there were many good people, but every time the Congress changed for 2 years, every 2 years, they had to reinstigate the bill. So to make a long story short, right there at the end of Biden's term, this was brought to fruition and it was passed. And it was due to, I want to say, due to GAE and GAE retired's efforts. And I'll tell you why. Because with all the other things that we had to do, it was kind of put on the back burner that, you know, this was not as urgent or as important because it probably wasn't going to, because this is a cost factor. And it probably wasn't going to pass considering all the other things that we had going on. But Tony and Karen and others got on their horse and they convinced GAE to take this at the NEA as a bill to ensure that this come back to fruition and come back to a priority issue. And to make a long story short, which I'm sure I haven't done, we did get it passed. But I do want to thank them. The day that it passed and I saw that, I called Tony and Karen and congratulated them for the hard work. But there were many others along the way that contributed to this. Dan Powers and I went up to testify at the NEA lobbying effort back 20 years ago. And we've all been working on this for a long time, but just thank you so much for everybody who contributed to this, everybody who wrote a letter to their senator or representative trying to get them to pass this. Now, I don't know when, as Anise says, exactly that this will be done, but it is law now, and those people who were jeopardizing, especially people like those people that were paraprofessionals or bus drivers, they don't get a very large retirement. We don't get a large one, but we get some that is sufficient. But they got even less, and it was jeopardizing them. We've had many members that suffered greatly because of the GPO and the WEP. And so thank you, everybody who contributed. That's it, Tony. You're muted, Tony.
Oops, I know I would do it at least once today. This is extremely good news, and thank you to all of you who helped us lobby to bring this to fruition. What we're going to do now is we're going to talk a little bit about the teachers' retirement system, which is very carefully monitored by our member Lisa Underwood, who does an extraordinary report on what happens at the TRS board meetings every other month. And this is information that will absolutely positively be important to you, because you need to understand how your pension is calculated. And then we will absolutely positively hear later from Mike Zerum of TRS, who will give us even more detailed information about the TRS system. But right now, Lisa, are you ready?
Yes, I am.
Okay, let me pull up your presentation
Thank you so much.
and share my screen.
And I will say, I really enjoy these meetings, the TRS board meetings. They go by quick. I mean, they rarely go over 1 hour, and the information is just terrific. And the people who, you know, make all the presentations and tell us about, I mean, it's very, very beneficial. And we do have other people, like Tony's usually in those meetings. We attend virtually, so they're Zoom meetings. And they're at 10:30 in the morning, so you don't have to get up too early, and you don't even have to turn your camera on. You can sit there in your pajamas, but the meetings are great.
And they are,
Okay.
the board is chaired by our own Debbie Simons, who is a past GAE president and a member of GAE Retired. And she does us proud. All right, Lisa, you just tell me when you want me to advance the slides.
Okay, go ahead to the next screen. Thank you. Okay, and I'm happy to see so many people are in this meeting today. These are your really great meetings. Even if you've already retired, I always learn new things. Okay, one important thing I do want to share with you, if you have not already created a MyTRS login, you need to go ahead and do that. Most of our retired people do have a TRS login, but it's my understanding from these board meetings that only about half of our active members have a MyTRS login. And this is important because you can go in and look at the pension calculator and get an idea of what kind of monthly benefits you'll have. So if you're at your 15th year or 18th year or 20th year about to pull your hair out saying, I can't stand it, I got to get out of here. If you will log into MyTRS and see what your benefit will be when you retire, it may be just enough to get you through to hang in there to the end. Okay, and that's very easy to do. Just get, this is the website. All right, go ahead to the next screen, please. See? Yes. Okay, our TRS fund is really incredible. It is very, very stable. As of December 2024, our TRS retirement fund had $110 billion in assets. We have 250, well, almost 251,000 actively contributing members. Those are our people who are still working. And then we have basically 153,000 retired members there, and those are the people who are taking checks out of the TRS fund. So as you can see, with almost 100,000 gap there, we have many more people putting into the fund than we have taking out, and this is very healthy for the fund. I will tell you that at one point when we had our economy was really kind of wacky, our fund did go down to about $89 billion a couple of years ago, but it has come back very quickly and is at the highest it's been. Okay, next slide, please. Okay, and this is just giving you some numbers. Service retirees, this we have about 137,000. And then we have our average monthly benefit. And this is average because you've got people like me who have been retired 2 years. Then you've got people who are over 100 years old now. We have several hundred members who are more than 100 years old. This is the average monthly benefit with all of us added up together, because mine's not that high yet. Okay. The average service credit, that's how many years of service people had when they retired, is a little more than 25 years. And I'm one of those who retired at about that time also, because I started kind of late. But I just thought everybody automatically worked 30 years, but a lot of us did make career changes and come in a little bit late. All right, the average age at retirement is 60. That's gone up just a little bit over the past couple of years. And the average age at payout is 72. And like I said, that's the average with all the people who retire when they're 52, all the way through those members who are more than 100 years old now. Our total benefit payroll, we've had $541 million. And you can see that's just a little drop in the bucket compared to $110 billion. So the fund is very, very stable. The electronic fund transfer, 99% of our retirees take their check from automatic draft. And our executive director did point out at this last meeting, he said he still has 1% of our retirees who want a paper check to come to them in the mail. And I know we've had conversations about this in the past, that the mail's been not very dependable sometimes lately. And Dr. Buster Evans, the executive director, said he wishes everyone would go ahead and have their their money transferred electronically because you get it. I mean, your money is going to be there the day they say it's going to be there. When the checks are in the mail, you know, sometimes those have had some terrible delays. Okay, next slide. Okay, I don't know why this is blurry. Anyway, because I mean, I put it in there, but I didn't realize it was that blurry. Anyway, this is just showing our net position, which is how much money is in the actual TRS fund. And you can see that it's fluctuated a little bit from last year, last January to December. And it's gone up and down a little bit, but it has continued to consistently grow. So that's the good thing. Over time, it just consistently goes up. Okay, next slide. Okay, next we're going to talk about the difference between a defined benefit and a defined contribution. Okay, and this is very important to understand how these are different. Okay, next slide. Okay, so when we compare the two types of plans, the defined benefit versus defined contribution. Right, next slide. And this is that video that is sometimes a problem.
We will see if it will play.
I don't know why it doesn't play.
Here we go. But we don't have sound. Hold on.
Risk growth investments. The plan is typically tax deferred, which means the contributions.
I heard it.
Can you see the video?
A pension plan is a retirement savings plan.
No.
An employer maintains a fund on behalf of its employees for their retirement. The money in the fund is usually invested in long-term, low-risk growth investments. The plan is typically tax deferred, which means the contributions made to the plan are not subject to income taxes, and in addition, the investment income of the retirement fund is also not taxed.
Taxes are only
now.
paid once money is taken out of the fund in
I
the
can see it
form of
now.
retirement income payments. This tax advantage provides employees with a lucrative way to defer part of their current wages and salary to retirement savings where it can be used as retirement income. Generally, there are two types of retirement plans: defined benefit plans and defined contribution plans. A defined benefit pension plan is a more traditional, older style of pension plan where workers' retirement benefits are calculated and thus defined by a formula that takes into account their years of work at the company and their salary history. The employer controls the plan and the plan assets and guarantees that the employee will receive a certain amount of retirement compensation no matter what the performance was for the underlying assets in the plan. A defined contribution plan is the more modern type of pension plan. Most people are familiar with these types of plans through making 401k contributions. In these types of plans, the employee controls the amount contributed to the plan as well as how the funds are invested. Retirement benefits depend on how the fund assets perform and grow.
Okay. So, you know, I mean, the places like if you invest in VALIC and things like that, VALIC and Lincoln and all these other things, those are your where you're making your contribution. Okay, next slide. Here we go. All right, the defined benefit is what we have from our TRS fund. The employer is responsible for investing the contributions you have on your check stub every month. If you're still working, you see how much money that comes out of your paycheck for TRS, and it goes into the school system, and then your district invests that money. They send it to TRS. I mean, they don't choose where it goes. They just send it to TRS, and TRS manages the money. Okay, then with the defined contribution, that would be the thing that you do on your own for example, VALIC, and then you choose, I'm gonna invest $100 a month with VALIC, or I'm gonna invest $400 a month. And you are responsible for investing those contributions, and you sit down with your representative and make those decisions. Okay, next slide. With a defined benefit, the amount of your income is known. Okay, and I said a few minutes ago that in October, a couple of years ago, our retirement fund, TRS fund, went all the way down to $89 billion, but nobody's paycheck changed. Everyone still kept getting their TRS check, no matter what the economy does, no matter what the stock market does, our checks would remain the same. Okay, with your defined contribution, you may have noticed when we had that hit a couple of years ago, if you looked at your investment in VALIC or whatever you have, Lincoln, you might have looked at it and said, oh my gosh, I just lost $30,000 or I just lost $50,000. So that defined contribution goes up and down with what the stock market does. Okay, so our defined benefit is not impacted. Okay, next slide. Okay, so our defined benefit, our TRS fund, it is protected from inflation, and we have survivor benefits usually built in because you have an opportunity to check when you set up your TRS and you're going to start taking your check. You can pick a spouse to receive some of the benefit if you die, and we can get into that a little bit more later. But you do have an option. You could take all of your money yourself, or you could take a little bit less so that your spouse can still get something after you die, if your spouse should outlive you. In a defined contribution, there is no inflation protection. Benefits for your survivor are not built in. All you could do is say, if I die, I'm leaving it to my husband or my child or whatever. But it's not set up where they're going to actually get a check. They would just get whatever's left in that account. Okay, next slide. Okay, the value of the defined benefit plan for educational policy. Okay, one of the things, this is very important. It's a great recruitment tool. I worked in business and private industry for a while before I became a teacher, but I had all these people in my family who were teachers. And I had all these like great aunts and things that were teachers. And I said, man, they've got really good retirement. Just see how they're traveling and going all over the place, going on trips. And I just really started looking at at the defined benefit as opposed to what I had in private industry, which was a 401k. Retention, I mentioned before that, when you're getting kind of in the middle of your career, sometimes you might have that rough year or that rough class or that rough student that just makes you want to pull your hair out and thinking maybe this is time to make a change. Please go to My TRS and look at your pension calculator. And when you see what your retirement benefit will be, it may give you just enough to keep on going and get through that little bad spot. We all have them. We've all had that year that made us almost want to leave. But if you could just get through it, the next year is usually better. And knowing you're going to have that money is a really good incentive to stay. Okay, and then you have retirement with dignity and honor. Thank goodness I have my TRS check each month because my other little investment didn't do so well for quite a while, where I wouldn't have wanted to take any money out of it because it had gone down so much. So we do want you to be able to retire with dignity and honor. All right, next slide, please. Okay, so we talked about the difference between the defined benefit and the defined contribution. Now we're going to talk about the TRS formula. And this is how your money grows. Okay, next slide. Okay, the normal retirement is where you have 30 years of credible service regardless of age. So those of you who started when you were in your 20s, you do not have to work until you're 60 or 65. In other states, many people are retired to work to they're required to work to a certain age. But in Georgia, when you have 30 years of service, you can retire even if you're only 52 years old. Or if you have at least 10 years of credible service and you're at least age 60. And I was able to retire with about 25 years because I had turned 60 and I did not have to stay for the whole 30 years. Okay, next slide. Okay, and here's the formula. Okay, we take your years of credible service, including partial years, and the multiplier is 2% per year. And then it's times the highest average salary, and that gives you your maximum benefit. So you just saw on the previous slide that if you are 60 years old and you have 10 years of service, you can retire. And with 10 years of service times 2, that would give you about 20% of your paycheck, which isn't bad for just having 10 years invested there. Okay, but then you have it times your highest salary, and that gives you your maximum benefit. Okay, next slide, please. Okay, so if you have 30 years of service times 2%, and let's say your high 2 years was $50,000. So 30 times 2%, you'd get 60% of your salary, which would be about $30,000, which would be $30,000 a year or $2,500 a month before taxes. So you take your years of credible service times 2% with your highest average salary, and it's high 2 years of average salary, and that gives you your maximum benefit. And the highest average is not the last 2 years. It's just the highest 2 years. Because, you may have a person who moved into administration and made more money, and then later on went back to the classroom and made less money. Your highest salary may not be your last 2. Okay, next slide, please. Okay, if you have 40 years of service, and then that's times 2%, if you had $60,000 a year, you're going to be able to collect 80% of that because it's 40 times 2. So you get 80%. That'd give you $48,000 per year or about $4,000 a month. And that's as high as it can go. It can't go higher. Like if you work 45 years, you don't get 90%. So at 40 years, that's the most it's going to be is 80%. All right, next slide, please. And I love the unused sick leave credit. This one really helped me, and it helped my husband a lot.
Sure did.
My husband worked 30 years at technical college, and he had 2 years of unused sick leave credit. So when he retired, he got credit for 32 years. And when I retired, I had almost 2 years of sick leave. So I retired, instead of having 23 years, I actually got all the way up to 25 years. So that's very important. So when you're having that, where you have that day that you just need a mental health break day, you might think about my retirement. I think I can get through it. Okay, next slide, please. Yes, 20 days of unused sick leave is 1 month of service. Yes. So 9 months of sick leave is, that gives you a whole year. Okay, for employees employed after not counting towards retirement. Okay, they did try to stop this. This legislation failed, thank goodness. They tried to have employees who came in after July 1st, 2020 to have them not be able to use their sick leave credit, but that bill thankfully failed. Okay, next slide. Okay, cost of living adjustments. This is another really wonderful part of our retirement. Okay, go ahead to the next slide. We receive a 1% cost of living allowance every January and every July. And so that's 3% a year. 1.5, yes. Okay, sorry, my husband's talking to me too. Okay, go ahead to the next slide. Okay, and then this is how is TRS funded. Okay, go ahead to the next slide. All right, bucket number 1, that is the money that you put in. That's the money that comes out of your paycheck each month, and goes to the district for them to send to TRS. Okay, that's the first bucket. And that's, you can see that's got the least amount in it. Okay. Then bucket number 2 is what your employer, what your school district contributes. And they contribute quite a bit more than you do. Okay. Then all of that money goes to TRS and they invest that money for our TRS fund. They do a fantastic job managing our money. They're very careful. We have one of the most stable retirements in the entire country. Okay, next slide, please. All right, and this is, let's just say that somebody retired in 2010 at age 59. Okay, that person over their entire career paid in about $46,000. The employer for that employee contributed $92,000. Okay, all of that went to TRS, and then TRS invested the money, and the investment income is $231,000 at this point after this person has been retired about 20 something years. All right. So the benefit payment received from 2010 to 2018, that retired educator had already received more than $370,000. You see the person only put in 46,000, and over that period of time has already collected much, much more than the employee invested or the employer invested. I just think that's a very exciting slide. Okay. Okay, go ahead and change slides, please. Yes. Okay, I mentioned a minute ago that that your employer puts in more money for TRS than you do. We have been where we have about 6% taken out for the last about more than the last 10 years or so. And our employer, if you look from 2012 going up to 2022, the employer's contribution has gone from basically 10% to almost 20%. And that is very helpful to you also. And that's how when you saw that previous bucket, you put in a small amount, the employer puts in more than twice as much as you do, and then it all gets invested for you to have when you're retired. Okay, next slide. And this is what it was in 2024. It's almost 20%. Okay, we had in 2020, I was still working when this happened. There was a House bill that they wanted to change how our cost of living is worded. They wanted to change it where it said, instead of the teachers will receive a 1% raise every January and July, they wanted to change it to may receive. And they wanted to change it so it could be 3% or less. They wanted to mess with the wording. And I may go on a diet and lose weight. That's different than I will. So we have beaten that down. I was working when these two things happened, but our retirees flooded the legislator with phone calls, emails, letters, and that's what our retired people do. Now I'm retired, but we have a bad bill that's going to hurt you. I'm going to be right there with the team trying to drag on our legislators to make them stop and not hurt us. And this bill did definitely fail. Okay, there's been all kinds of bad bills that people have come up with that would be bad for us. I mentioned taking away the sick leave accumulation. That failed. They want to change multipliers. They want to change the minimum age to retire. I can't remember what state it was. I just saw one that they have to work until they're 65, even if they start when they're 22 years old. So that would be terrible. But we have been very lucky in Georgia. You get your 30 years, you're done. Okay. Earning assumptions. There's just been a whole lot of bad legislation, and we have been able to beat most of these back, largely thanks to our GAE executive officers, our GAE staff, and our retirees who really, show up when they're trying to make a bill that's going to hurt us. Okay, you could go ahead to the next slide, please. How the legislation works, okay, we have a biennium cycle, and any legislation that has a fiscal impact can only be introduced during the first year of the 2-year session, and then it can be acted on during the second year. We are currently in the first year of a 2-year session, so there could be something, a bill made that would have a financial impact. It could, they could be introduced this year, and then they could be acted on and passed next year. They can't be passed this year. Right now, and we're early in the session, it's only January, we've got people, trying to keep things on the radar. If we see anything that has anything to do with our retirement, we will have people monitoring that and watching that to see what's happening, and then reaching out to legislators to talk to them. And our executive director of our TRS board, Dr. Buster Evans, he is very, very vocal with our legislators about anything to do with our retirement. Okay, go ahead. Next slide. Okay, then we had this piece of legislation in 2021. This was just give us a little bit more flexibility, give TRS board a little bit more flexibility with how to invest our retirement. And like I said, they do a fantastic job. They're very conservative, and that's why our fund continues to grow and our money is very, very safe. Okay, next slide, please. Okay, then we had our piece of legislation, House Bill 385 in 2022. That allowed retired teachers to go back to work, retired educators to go back to work in certain fields. Special education is the main one they go back to work in, and that is a wonderful thing for our students and for education, because that's a critical needs area, and you have an experienced, seasoned teacher who goes back in to work with our special ed kids, and that's just a great benefit for our school districts and for our children. This will probably have some action on it this year during the legislation. Dr. Evans said at the board meeting Wednesday that this has a sunset date on it. So if it's not acted on this year to extend it, it will sunset and go away, and all those retirees who were able to go back to work, people won't be able to keep going back to work. So hopefully also, if they do take some action with this legislation, they would also broaden the scope of where teachers could go back to work, because right now there's not many spots. There's probably some high school, maybe science and math, that, like, if you're a kindergarten teacher, you can't go back to work under this legislation. And when I was retiring, we really were having a hard time finding kindergarten and first grade teachers. So maybe they can, extend this and make it where more people have an opportunity to go back to work if they want to. Okay, next slide. Okay, and that is the conclusion of my presentation. Does anyone have any questions? And you will receive more information when we have somebody from TRS who will also be talking to you, who will add more information and could add on to some of the things I just said. Thank you so much for coming today. Like I said, I'm just delighted to see so many people here, and congratulations on those of you who just retired and those of you who are planning retirement. I'm glad you came to learn.
Okay, there are a couple of questions here. What happens with sick leave less than a year? Remember, it takes 9 months of sick leave to make a year of service. And as far as the bus drivers are concerned, in Georgia, our bus drivers are a part of another retirement system called the Public School Employees Retirement System, which is abysmal. PSERS pays an average pension of between $290 a month and $200 and $520 a month, and that is not a livable wage. We had a legislative victory last session where we were able to remove the cap on the multiplier. But still, that has not made a significant difference in the outcomes for our bus drivers, our cafeteria workers, our maintenance workers. And so they are still a part of the Public School Employees Retirement System, PSERS, which is going to require a lot of reform. Part of the problem is that these employees are not paid a living wage. So their contribution into the system is limited by what they can afford to pay. And so it is a GAE legislative priority to reform this system and also to make sure that people in those job categories are paid a living wage. So when you are at the GAE Retired Virtual Day at the Capitol, you learn more about PSERS. And when you are at the GAE Day at the Capitol, you will learn more about our efforts to reform the public school employees retirement system so that all of our job categories of education support professionals can receive a pension in retirement that will allow them to have independence and dignity. Are there any questions?
Well, Tony, if I could add, with the sick leave less than a year, there's a formula that like every 30 days or something that that you get something for those sick days. So if it's less than a year, if it's half a year, if you just have half a year of sick days built up, then you would retire with 30 and a half years instead of 30 years or however many years you had. So you do get credit if it's under a year. You just don't get the whole year. So, okay, that's all. Thank you so much.
Patrick's hand is up. Patrick's hand is up.
I had to unmute. I just wanted, I have another meeting I'm having to go to. I just want to welcome everybody, thank them for coming. All this good information is the reason why you should become a GAE Life member. And Tony will finish out the meeting. And I just want to welcome everybody and let you know that we are here working for you. And all this is happening because of GAE Retired. So, but thank you, Tony, for all you do and for this event, which is very important to us.
All right, thank you.
I can't raise my hand, Tony.
Yes.
When is GAE Day at the Capitol?
It is the 20th of February. I think that's a Thursday. We can't, Patricia, we can't do Day at the Capitol on the weekend because the legislators are not there on the weekend. So we have to go on a day that the legislature is there.
How do you join that? Participate in GAE Day at the Capitol?
I will look for the link and put it in the chat. It's a very worthwhile process, and I will put that in the chat. And there's a question about whether you can join GAE Retired online. We cannot do that right now, but I did put in the chat, and I'll put it again, a link to our webpage, which has our a link to our application, lifetime application, and our pre-retired application on there, and you can print that out and take a picture of it and text it to me, and I can submit it to membership, and your membership will start. So one of the things you should do is join as a pre-retired member while you are an active member so that you can take advantage of a cost for lifetime membership that is lower than it might be when you retire. I joined for $200 and now the cost is $400. So when I retired, it was $350, but because I joined as a pre-retired member, while it was $200, I saved $150 on my lifetime membership. So I will put that link in the chat again for you. Are there any other questions? All righty then. Now we are going to watch a recording about legal decisions that you need to make prior to retirement. I'm going to ask for grace while I pull this recording up. We will, this is actually a recording from a previous pre-retirement seminar. And if you will give me a moment to pull up this recording, we will get started. And then after that, Mike Zarum from TRS will join us, and he will share important information about the teachers' retirement system. Hold on, I'm having technical difficulties, but I think I can get this going. How many sick hours equal a year, and how many sick hours equal a year? Lisa, are you still with us? Can you share that with us, please?
Yes. Okay. And we had one of those slides that if you have 20 sick days, that equals 1 month. Okay, so 20 times 9, you'd have to have about 180 days to have a year. So if you did 8 hours a day, you'd have to multiply it that way. How many sick hours equal a year? Because you'd have 180 times 8 would do it. I can't do that in my head. I'm not a math teacher, not a high school math teacher. Okay. Because 180 times 8, that's about 1,440 hours would be 1 year.
All righty. I think I have the recording queued up. And so we are going to watch information from Robin Lacrimosa on legal things that you need to be aware of before you retire.
A moment, and we are good, I think.
Perfect. Well, thank you for having me. My name's Robin Lacrimosa.
I'm at Kimbrough Law, which is an elder law firm. We have offices in Athens and Gainesville. And we basically help folks figure out the legal, financial, and care parts of aging. So we can go to the next slide. So there are 3 things that every person should have. We see this mostly with people as they're aging and retiring, but honestly, we recommend this for anyone over the age of 18. And so that's that they should have a last will and testament, a financial power of attorney, and a healthcare power of attorney. And those are 2 different things, and we're going to talk about those. Next slide, please. So the reason having a last will and testament is important is because if you do not, Georgia law determines who receives your property. A lot of people assume that their spouse will receive everything or their children, but that's not necessarily the way it works. So depending on how many children you have, your spouse may receive a half or a third of your property, and the rest will be distributed among your children. This is if you die without a will. And that becomes complicated because sometimes people are estranged from their children. Sometimes it's not in the adult child's best interest to inherit a large amount of money at one time without any kind of guidance. Sometimes there's issues. We've had people who have remarried and they assumed that the spouse would inherit the house, but they didn't. And then there's those blended family issues. So that's why it's important that everybody have a last will and testament. So next slide, please. So the other thing that happens if you don't have one is it makes the probate process more complicated for your family, which unfortunately, when you are talking about legal matters, complicated means more expensive. So they have to, everyone pretty much has to petition the court, but if they have a will, basically that's a really simple process. They go and get assigned as the executor. But if you don't have a will, then things have to be advertised. They have to get a court order to sell anything. And like I mentioned earlier, there may be unintended consequences for the children or blended family children or the spouse. So next slide, please. So what happens with one? Basically the opposite of everything that I just said. Yeah, whoever is you wanted to get your property is who gets it. I think that families are complicated, so having a last will and testament cuts down a lot on any potential fighting. People bring all of their childhood hurts or misunderstandings and miscommunications with them throughout their adult life, and then sometimes when they're in a really stressful situation, such as an unexpected death, it's not always, family dynamics sometimes do not always come out in the best way. So basically having a last will and testament makes things much easier. The other thing that I would mention that's really important is if you have a special needs child that you are leaving any money to, you want to make sure that you have spoken to an attorney, because if they're receiving state benefits, you don't want them to inherit a large amount of money from you, because that may have a negative impact on any state benefits they may be receiving. Next slide, please. So your financial power of attorney, this is where you name an agent. We actually recommend that you have an agent and a backup. This is someone who's going to make financial decisions for you if you are incompetent, you are unable to do that. And so if you do not have someone named as your power of attorney, and you have something happen. So we have a client who his wife was going in for what she thought would be a routine surgery, and she unfortunately had a massive stroke, and she's no longer competent, but he did not have a financial power of attorney. So he is actually having to go to the court to try to get guardianship so he can sell some of the property that they own to help take care of her. So if you do not have a financial power of attorney in place and something happens to you, then first of all, you lose your agency in deciding which agent you want. So sometimes it becomes whichever family member is going to step up, but it gets much more complicated and again, more expensive for your family, because they have to petition the probate court. They have to apply for guardianship and conservatorship, which means that basically annually they have to show the court how they are managing your money appropriately. And everything comes with court fees. So that's why a financial power of attorney is really important to have in place. Next slide, please. So this is kind of what we've talked about. If you have one in place, then your agent can immediately step in and they can access your bank accounts. They can sell your property if they need to. There's nothing that involves the court necessarily. So that makes it a lot easier. And we have some families, you have the option, you can name one agent. We always suggest you have a backup in case your agent may be out of town. We have some families that they have children that they want to work together. So they set it up where it's child A and child B have to make decisions together. Or we have some that is the last thing that they want, and they want child A to make the decisions. So it just depends on each situation. Next slide, please. And then the advance directive for healthcare, this is separate. So sometimes people get confused when we say power of attorney and we use them kind of interchangeably, but there's actually two separate power of attorneys. This also used to be called your living will. This one, if you already have a living will and you don't have any changes to it, you do not have to redo this document because they changed the name of it. But this is basically where, similar to the financial power of attorney, you're naming an agent who's going to make your healthcare decisions for you. You do have places in there where you can share what you want, whether you want CPR, whether you want to be kept alive on a ventilator, and then you also name an agent who is going to speak for you when you cannot. This is really important. I worked in the emergency room for 14 years as a social worker, and I always say this is the best gift that you can give your family, because in a really stressful situation, it's really hard to be that person to say, even if the doctors are, they'll share to a certain point, but everything is your decision. And so if you have spoken with your family and they are aware of what your wishes are, what you would want to happen, or you have this in place, then those decisions can be made. So for example, I am my father's healthcare power of attorney. I actually don't live as close to him as my sister. They live on the same property, but my sister would just not, she hasn't worked in the health field, and my dad says she's too smushy. He wants me because he knows I will make the hard decisions and do what he wants. So those are just things to think about. Again, you can make this where you have where the children have to work together, or they can be completely separate. And they don't have to be your children. I have a lot of, we call them solo agers, and they have their friends, their lifelong friends or other family members that make those decisions for them. So this is a really important piece of paperwork as well. Next slide. So one of the things we talk a lot about at our firm, and is just something good to know in general, is asset protection. So here in Georgia, if you had a catastrophic event and needed skilled nursing care, you basically have to spend almost all of your money. If you're single, you do have to spend all of your money before you're eligible for state benefits. Currently, nursing home care is about $9,000 or $10,000 a month. If you are a single person in Georgia, you can only have $2,000 in your name. If you're married, your spouse, your community spouse, can have, I believe it's $142,000. So you'll hear people as you start aging. We have a lot of clients who have maybe recently had a diagnosis, or they've had a health scare, and they recognize that this is something that they might need. For a lot of people, it's really important that they have assets to leave to their children or their grandchildren or their charity. I mean, you've worked really hard all your life for this money. So what do you want to do with it, and how can you protect it? So here in Georgia, you can't just put everything in your children's name and then apply for Medicaid for state benefits the next day. The state has figured that out. So there is a 5-year look back. So those are some of the things that are kind of important. Can you go to the next slide, please? So what we usually recommend is there are trusts. There's a lot of different things, and that's really where you're going to come in and talk to the attorney. But there's a lot of different options. You can put things into a trust that then protect them from being considered your assets. They also can protect you from liability, such if you have a car accident or someone tries to sue you. And you can name your child as a trustee if you have a child that you trust. So the reason we say it's not a good idea to just transfer all of your assets to children is, one, like I mentioned, there's that 5-year look back. Secondly, there's potential capital gains and tax implications for your children. Sometimes, and people laugh when I say this, but sometimes you might not like the person that your child married, or you may love the person that your child married, and then you transfer all your assets and then they get divorced. And then now your assets are in your daughter's name. So now those are considered her assets, and her now to be ex-husband can come after them. So things get really complicated. So it's not just as simple as moving things to your children. There's, like we said, some liabilities on them. The thing is there's no restriction. So that basically becomes your child's money. And so, like I said, families get complicated. People get married, divorced, remarried. So it's not always the best way to handle that. The one other thing I will say here in Georgia also is that they do estate recovery, which basically means if you own your house, that doesn't count as an asset. If you needed, say, skilled nursing care, then what will happen is after you've passed away, the state will say, we spent $100,000 on your care. You have this home that was in your name that's worth $400,000. We want our $100,000 back out of your home. So that gets a little complicated, and there's things you can do to kind of set that up. I've seen families that the child has moved in to care for mom with the assumption that the daughter would just get the house, and then mom needed nursing home care, and it gets really complicated. Next slide, please. I feel like I'm gloom and doom here on this, but this is important stuff to know. And I always say knowledge is power. So, does Medicare pay for long-term care? Absolutely not. I have had a lot of folks who kind of are like, oh, well, I have Medicare and I have insurance, so I'm fine. Medicare was designed to get you better. So it's basically a rehab. It's very short-term. It's not going to pay for skilled nursing care. It's not going to pay for long-term care. So if you have an illness, you have Alzheimer's, you have Parkinson's, you have COPD, really any of those kind of long-term chronic conditions that you're going to need assistance with, you're going to need care help at some point. Medicare is not going to be the solution that you might hope it will be. Medicare is great if you have a surgery or you have a fall, you need rehab, you need to rebuild your strength, and then you go home and maybe rehab and home care comes in, which would be someone who comes in and kind of helps you around the house, make sure you can get in and out of the shower. But that is very limited. And you can see on there, it says 100 days in a skilled facility. So basically, if you have some kind of surgery or hip replacement, broken hip, you go to rehab, they're going to pay for 100 days of skilled nursing care. But it is kind of tiered. So the first certain amount of days, I think it's 60 days, are free. And then you start paying a copay. And then after 100 days, if you are still in that skilled facility, you're going to have to start paying out of pocket, which is going to be that $9,000 or $10,000 a month. Most health insurances do not cover that. And then also if you need to move into assisted living, those are also all pretty much out of pocket. They are not covered by Medicare or Medicaid. Next slide. So one of the things we like to talk about is what money is available to you as you start to age. This is one of the things we talk about a lot at our firm. Mr. Kimbrough, our attorney who started our firm, actually did this for his mother-in-law and how he got interested in this. So there is a pension plan for veterans who served during wartime. And we see a lot of folks looking to this pension when they start to need care, whether they need to move into assisted living or they want to have someone come into their home and help take care of them so they don't have to move. So this is just a potential, basically money stream for those who qualify. Next slide, please. So the VA doesn't really publicize this. I will readily admit that I have been in social work here in Athens for probably 20 years, and I didn't know about this until I started working at the law firm. So the VA does not publicize it. The VA does not make it particularly easy to apply, which is part of the reason why we've started helping people with this. Next slide. So how do you qualify? The first one is that there are certain dates of service for these wars that are listed here that the VA has determined as eligible dates of service. I don't include those in here, but anyone is free to reach out to me, send me an email afterward, and I'm happy to discuss this with you and see if you'll qualify. And I guess I should say this is for the veteran, and if you were legally married to a veteran when they passed, there is also a surviving spouse benefit. So we see that sometimes as well. So next slide, please. So the first part is dates of service. That's usually where we start. The second requirement is age and health status. So you have to be at least 65 or older. You have to be retired. Your surviving spouse can be any age, and then you need assistance with 2 activities of daily living. Now, I will say it's a very low bar. Basically, you just could have grab bars in your shower. If your doctor says he would recommend you use a cane, even if you don't use the cane. It's some of those kind of things, just some assisted devices can help you qualify. Next slide. And then the third one is financial. And this is where folks who apply through the VA will get denied, because you basically have to have more medical expenses than gross monthly income. But there are things that we can do to offset some of those costs. So you would be eligible for this benefit if you meet the other requirements. Next slide, please. And so this is why it's important. This is a lot of money. If you are a veteran with a dependent, which basically means that you're married or you have a special needs adult child that you're caring for, you could be eligible for up to $2,642 per month. That's tax-free for the rest of your life. And then the surviving spouse benefit is $1,432. That's important, especially for the older generation, older than you all, because a lot of times the women maybe worked or they worked part-time. So when the husband passes away, their income really goes down. So this is one of the things that we are, really trying to spread the word about and make sure people realize that this is a pension that they earned for serving during wartime when we needed them. And the other things are they have to have been honorably discharged and they have to have been in full-time military service. So unfortunately, the reserves do not count for this pension. Next slide. And then the last thing I'll talk about is kind of what we call life care planning. This is something we do at our firm. We basically take a holistic approach. So basically you come in for legal and financial help, and then if you have care needs, we can help with that. We call basically the long-term care maze. It is a maze. Everything is very siloed as far as care as you get older. And so it's a little hard to access services. So Mr. Kimbrough, our attorney, realized that people were coming in and he could help them make plans, but when it came to care needs, he didn't really know what to do. So that's kind of, I'm a geriatric social worker. There are other law firms throughout Georgia. I think there's 3 of us that do this. So if you're not in our area, but it's something you're interested in, I can certainly hook you up with an attorney that's close to you that also does this. And basically our attorneys, my clients engage with me for a year at a time, and they have unlimited access. So we kind of set up a plan for them. And then if they have a crisis, that's when we kind of step in. Next slide, please. So this just kind of shows how our firm works, how these things all intersect. Because really, as you age and you start looking at how you want to make sure you're protecting your money and that you have all of these documents, everyone's going to have care needs. I think the statistic is 7 out of 10 older adults will need some type of long-term care at some point. Now, that doesn't mean everybody's going to end up in a nursing home, but you may have, like I said, a surgery that requires some rehab help, different things like that. So the care part of it is really important. And unfortunately, the aging services have not done a good job about making things easily accessible. It is a bit of a maze. Next slide, please. So these are kind of the benefits. And what I always tell people is, and I'm guessing a lot of you, as you're getting ready to retire, or just recently retired, don't have care needs necessarily right now. But what I tell everybody is you want to be thinking ahead. You come at a place of power when you have planned ahead rather than waiting until a crisis and trying to figure something out. So I liken it to like a phone tree. So if you suddenly had to go to the emergency room, who are you going to call? Who's going to be at the house to take care of your dog? Those kind of things. And if you kind of have a plan in your head, it's much less stressful and much easier to kind of start implementing that plan. So these are some of the benefits. We call it life care planning. It's really just planning, kind of like you're doing at this webinar, just kind of planning for the future. You get the right care, you get what you want. If something's happened and you haven't made any plans or haven't really thought about it, sometimes you end up doing what your children think is best for you, and that's not always what might be what you want. If you are a caregiver, so unfortunately for a lot of our folks, if you are married and you might end up being a caregiver for your spouse. We see that a lot. And so that's a lot for the caregiver. So having some support and having some plans in place, because one of the things I used to see in the emergency room a lot was I would have a spouse who was maybe caring for their husband or wife who had Alzheimer's, and then the caregiver got sick and had to have surgery. And everything was overturned because the caregivers are the wheels on the bus. They're the what keep the bus on the road. And so when the caregiver gets sick, everything kind of goes sideways. This is also really important to think about if you have special needs children. As you age, you need to be thinking about putting plans in place for them as well, because inevitably, I mean, it doesn't matter your age, life is uncertain and things can happen and you can get sick and need to go into the hospital and you need to have a plan in place. So that's basically the most of it, and how this kind of ties in with the legal stuff is when you are planning ahead, you make the decisions about what you want to happen to your money, what's important to you, and you can set all of those things into place. Next slide. I think I'm almost done. So yeah, it basically puts you in the driver's seat. That's the big thing. And all of this puts you in the driver's seat, the legal paperwork as well. So that's kind of the down and dirty really fast. I don't know if there's any questions.
For those of you who came in after Robin started, I did mention that I will be sending you a follow-up.
Okay, and that, of course, is a recording from a previous pre-retirement seminar. The question is, how do I find a local firm for help with VA benefits? We will, when we send out the link to the recording, send information on how to contact this law firm and another law firm. That information is not to be construed as an endorsement. They are simply people who have worked with us in the past to bring you this information. And whether or not there is a consultation fee, you will have to negotiate that with them. Just let them know where you got their contact information from. GAE Retired. Okay, now we are going to hear from the man of the hour, Mr. Mike Zerum. I'm going to make you a co-host, Mike, so that you can share your screen. Mike is from the Teachers Retirement System, and he is going to give us answers to those questions you had when Lisa was presenting. He is going to give us the real from the horse's mouth information about the Teachers Retirement System, how it operates, and what you need to know and the decisions you need to make. So Mike, whenever you're ready to start, you may share your screen and begin. And I can't hear you, Mike, because you're muted. There we go. And remember to unmute yourself.
Am I unmuted?
You are now, yes.
Great. All right. Good morning, everyone. Let's take questions through the chat box. I can address them at the end. I think that way is most effective. But over the next hour, we're going to look at the plans you can choose from. In terms of the payout options, when you're within 6 months of retirement, you can pick from among them. We'll look at what's called creditable service, which is your membership service, unused sick leave, and service purchases. That's part of the formula we use to compute for benefits. Then we're going to close off talking about beneficiaries. You know better than anyone else that you do certainly deserve a great benefit for all the years you've been teachers. It's a very challenging position. And it's nice to know that you indeed get a fantastic benefits package when you take into account your TRS and the fact that you can keep your state health benefit plan into retirement and have the premium deducted from your TRS check. And it's they're both lifetime benefits that can't be taken away from you. And when you If you take a survivorship plan at the time of retirement, when you pass away, assuming it's first, your survivor also has a lifetime benefit with cost of living adjustments, as long as there's inflation. Your benefit, it's nice to know that what you get from us is in no way, shape, or form connected to the ups and downs of the stock market. It's based solely on that formula. Now, obviously, you're likely to have other investments in the market, but for your foundation, which for most of you TRS is, there are no concerns about investment security, which is a very comforting feeling. Good. Let's look at the benefit formula. We're going to take your years of creditable service. That's your day-to-day membership service, your unused sick leave, and also service purchases. And we're going to add all those up and multiply that by 2%. And then we're going to look at your whole TRS career. And we're going to say, where are the highest consecutive 24 months? A lot of teachers think it's 3 years, 5 years, or it's your last 2. It's actually wherever the highest consecutive 24 months happen to be. So we're going to multiply that all together, and that's going to generate what's called your basic monthly benefit under the maximum plan. So I'm wondering if there's a way to mute everyone. Tony, can you mute everyone?
I am trying to find who that is. If you are not muted, please mute. We can hear your conversation.
Okay, so we're going to multiply your years of creditable service times 2% times your high average salary, and that's going to yield your monthly benefit under the maximum plan. That's the most you can get from TRS. And it's pretty easy to figure out. You work 30 years times 2%, you're going to get 60% of your high average salary. All the other options that we have available are going to be some kind of actuarial reduction from whatever your individual maximum benefit is. So what we would pay under the survivor plans is sensitive to your age and the age or ages of your beneficiaries at the time of retirement. Now, once you start getting a benefit from us, certain deductions that you're used to seeing come out, stop. All the payroll taxes, things like Social Security, if you were paying into it, Medicare, that amounts to 7.5%, won't come out of your TRS check. And then TRS won't come out of your TRS check. And that's 6% right there. Once you're age 62, retired, living in Georgia, there's a special exemption on the first $35,000 of your retirement income. You don't pay any state tax on that, and that saves you 5%. And that exemption grows. Once you're age 65, living in Georgia, that exemption grows to $65,000. So the vast majority of our retirees living in Georgia are not paying any state tax on their TRS. And, there's clearly no 403B deduction coming out. So when you put all these things together, your take-home pay in retirement starts to look closer and closer to what the take-home pay was while you were working. But there is one deduction which I think most, if not all of you, want to see continue, and that is your state health benefit plan deduction, which will default to the plan that you had prior to retirement, and that amount will come out of your TRS check. And then every open enrollment period, retirees have something called the retiree option change period, and you can change your options. It's not a true open enrollment. You can't pick it up for the first time if you didn't have it before retirement. If you cancel, you can't get back in unless you come back to work. But if you get married, for example, you do have a window of opportunity to add a new spouse, or maybe you adopted a child, something like that. They do have qualifying events. But our role in your health insurance from the TRS side is simply to take the money out after the health plan says you're eligible, and then we remit that money back to the health plan, and that's the extent of our involvement. So if you have any questions about eligibility, what's covered, how you transition into Medicare Advantage when you're 65, those questions can be directed to the state health benefit plan. I don't know if any of you are Board of Regents. They have a separate health plan you can continue as well.
It'll be 60 on Tuesday, thank God.
60 on Tuesday, that's great. But if you could mute, that'd be even better. Eligibility for normal retirement happens when you have 30 years of service, regardless of your age, or you become 60 with 10 or more. Either of those thresholds would entitle you to an immediate benefit. But I may not have mentioned it when we looked at the formula, but you can go all the way up to 40 years and get 80% of your pay. So the only thing that's magic about 30 is that you could immediately retire if you wanted to. The other way would be a disability retirement. If you can't perform your job as determined by the TRS Medical Board and your providers, you would only need to be vested with 10 years of service, and you could start an immediate benefit without a penalty. And speaking of penalties, if you go out early and it's not a disability, you do have penalties. But to be eligible for an early out, you have to have at least 25 years of service, but obviously less than 30. You have to be under age 60, because if you were 60, all you would need is 10 years, right? So if you fall into that category and feel the need that you need to retire, you can start collecting with a penalty. And that penalty, I'm going to simplify it, but basically for every year you're under 30 years of service, or for every year you're under 60, we would reduce your normal benefit by 7%. So whatever penalty is the smallest based on age or service, that's what we would apply to you. So the penalty can be all the way up to 35% less of your normal benefit. If you do take an early out, you can't get a cost of living adjustment until you would have had a normal retirement based on age or length of service. All right. Now you're within 6 months of retirement. It's your window of opportunity to start deciding the specifics of your retirement. And that, for the most part, includes what option you're going to take. And there are, as you can see here, 7 different payout options you can choose from. And we're going to kind of go through an exercise where you may want to apply the same decision tree model to your situation in trying to determine which of these 7 options is best for you. And the first step is to break these 7 different payout options into 2 groups: Plan A, maximum, and Plan B, option 1. Those maximize what you're going to get from TRS, but they do not leave any monthly lifetime survivor benefits. So when you pass away, the benefits stop. No one continues to get any kind of income. But for that reason, you're going to get more money from us while you're living. And then conversely, we have options 2 through 4 that leave varying amounts of money to one or more beneficiaries, and essentially the more you leave them, the less you're going to get, and vice versa. And conceptually, I think it's important to understand that in your TRS account, before we look at them in more detail, you have two buckets of money. One I'll call your bucket of money. The other I'll call the TRS bucket of money. And in your bucket of money is all the money that came out of your paycheck, the 5 to 6%, plus the interest we've paid you, 4.5% on your money. And we call that your contribution and interest account, or I like to call it your bucket of money. We never keep any of the money that went into your bucket. If you die before it's used up, we'll refund what's left in it in a lump sum to a designated beneficiary, or it ends up in a lifetime monthly benefit. In the other bucket is all the money your employer has put in and all the money TRS has put in, such that when you use up your money in your bucket, your lifetime benefit and any survivor benefits come out of the TRS bucket of money, which never runs out. Okay, so this is a concept that's important to understand when we talk about the options and also payouts to beneficiaries. So let's look at the plan options in more detail. Plan A maximum is the formula that we looked at a few minutes ago. That's the most you can get. Now, your bucket of money lasts about 2 to 3 years. And if you die before that 2 to 3 year period runs out, anything that's left is given to your designated beneficiary in a lump sum. About 2/3 of our retirees take the maximum plan. That doesn't make it the right one for you. I'm just usually asked, who takes what, but it is certainly the most selected plan. Then we have Plan B option 1, which puts a little twist on the buckets of money, in that your very first checks from us are paid out of both buckets of money, your bucket and the TRS bucket. So consequently, your bucket of money lasts longer. Instead of the 2 years, it lasts 10 to 14 years. So if you were to die before the money in your bucket's used up, you're going to have some to leave in a lump sum to a designated beneficiary. But remember, there is no lifetime monthly benefit under either of these. So you get a little bit more protection under Plan B option 1. All right. And to have Plan B option 1, you take a slight reduction from whatever your maximum benefit was. There might be a % or 2. But for all these options, the exact reduction would be reflected in your benefit estimate. Now, as we begin to discuss options 2 through 4, I think it helps conceptually to think of these plans working like a ride on a teeter-totter, in that the more you leave to other people, the less you're going to get, and the more you take for yourself, the less becomes available for other people. You just decide where on this teeter-totter ride you want to get off. There's no right or wrong answer. It's just what works best for you and your family, helps you meet your goals. All these plans from a TRS perspective have what's called actuarial equivalence, which regardless of the plan you pick, plan-wide, they all have the same cost to TRS. The total expected lifetime payout is the same under all the options, but you can individually tailor it to meet your needs the best. So with option 2, you can leave 100% of your benefit to one or more beneficiaries. So for example, if you took option 2 at retirement and you pass away making $4,000 a month, that same $4,000 a month would go to your beneficiary. So it's very rich for them. And because of our teeter-totter concept, option 2 is going to cost you more while you're both living. The reduction is somewhere, generally speaking, I would say 10 to 25% less than your maximum benefit. But again, you won't know what your reduction is until you see your estimate. Going to option 3, they get half of your amount. So in our example, if you were getting $4,000 a month when you pass away, TRS would pay $2,000 to your beneficiary. They'd get half. Now, while you're both living, you would get more relative to option 2. I would say the reduction is anywhere from 5 to 15% less than your maximum benefit. Okay. Now, both options 2 and 3 have a sister option called the pop-up. If you want a pop-up, you can only designate one primary beneficiary. Under all the other plans, you can have as many as you want, but under the pop-ups, you can only have that one primary beneficiary. And if that one primary beneficiary dies first, your benefit, as the name implies, pops up to the maximum plan of benefits. Normally, when someone passes away, we don't need more money. We don't need as much money. So when might a pop-up come in handy? Well, probably not in too many scenarios, but maybe you're relying to some extent on that beneficiary's income. Maybe they're going to be working during most of your retirement. If they were to pass, you'd want some of that income replaced. Well, you could do that through a pop-up. The typical pop-up I see is maybe $300 or $400 a month. It doesn't cost a whole lot, relatively speaking, to add a pop-up to either option 2 or option 3. It might be $100 less per month to add the pop-up to the respective options. Otherwise, they work just the same as the normal option 2 and 3. And then last but not least, we have option 4, which within certain limits allows you to customize what you're going to get and what your beneficiary is going to get. So if the other options I described a moment ago don't seem to fit your scenario the best, you could tweak it. You might want to leave 75% of your monthly benefit to a spouse, or maybe 33% to a spouse, or you could leave a fixed dollar amount, like $1,000 a month, if that meets your needs best. You can't give it all away. You can't do anything that would reduce your benefit by more than half, but you certainly can do a good bit of customizing if you so desire under option 4. Okay. Now, I deem you all experts on TRS payout options, so it's a good time to give you a quiz. And normally, if I was there in person, we could make this more interactive, but I'm going to go through the exercise because I think it's a good mental process you may want to use in deciding which option is best for you. They're oversimplified scenarios, but at least it gets you thinking along the lines that will work. So in scenario 1, we have Mary. Mary has no dependents, and no one depends on Mary's income. So if you were Mary, what option might you reasonably choose? You don't have to answer me, but think about that for a second. In our way of thinking, Mary would reasonably choose the maximum plan. No one's going to have a financial hardship if Mary were to pass away and the TRS pension stopped. So Mary's going to enjoy the fruits of her labor, the 30 plus years she worked as a teacher, and take as much money as she can from TRS under the maximum plan. In scenario 2, we have Sue, who does have a spouse, but that spouse has no savings, won't be getting a pension, won't be getting Social Security, and despite all his efforts to win the lotto, he has not yet done so. And for the sake of argument, we have to assume that Sue does in fact love her spouse. All right, now if we take that premise and you were Sue, what option might you reasonably take? And in our way of thinking, Sue would take a plan that provides the most protection she can offer to her spouse, which would be option 2. So if Sue were to pass away first, then that spouse would still be getting the same amount of money that she had while they were both living. And then lastly, we have Tom, who also has a spouse. The spouse, in this case, will be getting a pension and Social Security. But when they run their numbers, the spouse is still $500 a month short of meeting her income replacement needs if Tom dies first. So if you were Tom, what option might you reasonably select? Well, our thought is you would reasonably select option 4, the one where you can customize it. And how much would you leave under option 4 to Tom's spouse? Well, that $500 that they're short. That way, that if Tom dies first, the spouse will get that $500 a month, which will cover all her basic income replacement needs. Okay, Tom could certainly leave her more than that, but then they would be getting less per month while they're both living. So in a nutshell, that gives you an idea of the thought process you might want to use in trying to determine which is the right option for you. Now, after you've decided on the option you want, there's another decision to make, and that's whether or not you want to leave a partial lump sum option plan, or PLOP for short. That's a lump sum distribution of cash at the time of retirement in lieu of a permanently reduced lifetime monthly benefit. Basically, for every $1,000 of PLOP that you might want, it reduces your monthly benefit anywhere from $7 to $10 a month. And your reduction will be shown on your benefit estimate. Now, you can take anywhere from 1 month to 36 months of your maximum benefit in a PLOP. About 1 in 10 of our retirees takes a PLOP distribution, and the average gross amount for a PLOP is somewhere between $60,000 and $70,000. And you can do whatever you want with the money. You can roll it over into another qualified retirement plan like your 403B and defer taxes on it. You could put it in your pocket to buy things and pay taxes on it. I've seen some people use it, to buy a depreciable asset like a auto or a boat. It may make sense to pay down some high interest credit card debt at the time you retire. Some people use it as a quasi form of life insurance, but most people don't get one. 9 out of 10 people don't take PLOP, and I think one of the main reasons is it's a rather significant monthly reduction for each $1,000 that you're taking. Because remember, your cost of living adjustment is based on your gross monthly benefit. So not only are you getting less per month, you're also getting less when the COLA comes around. All right. Speaking of COLAs, they're awarded to our retirees twice a year, every January and July. It's 1.5%. So per year, it's a little over 3% because of compounding. Once you've been retired 12, 13 years, your monthly benefit is 50% more than when you started. And I can't tell you how many retirees I have talked to who come running up to me, all smiles. Mike, I'm making more now in retirement than I did while I was working. And it's because of the magic of these cost of living adjustments. So it's a marvelous component or part of your pension that people find of extreme value, which it is. It's awarded as long as there's inflation as measured by the Consumer Price Index. And your very first COLA is cycled in, depending on your retirement date. Takes anywhere from 7 to 12 months to get your first one. But then after that, you're cycled in. It's every 6 months. And if you're the typical classroom teacher whose last day of work is in May, you're a June 1 retiree, which means your first COLA is 6 months later in January. So most of you are probably in that boat. So now we're going to go ahead and look at a benefit calculation. This member will retire June 1 of 25 with an average high salary of $5,800. And he'll have 30 years of service. So when you take 30 years of service times 2%, he's going to get 60% of $5,833, or exactly $3,500 a month. So we're going to carry this example into the estimate. Now, this is the top half of the estimate. We'll look at the bottom half next. And we do recommend you get one of these when you're 2 years out. You can get them as much as 5 years out from us. We think the optimal time is at 2 years. If something doesn't look right, there's still plenty of time to investigate it and fix it. If you want to do them on your own, you can. And you can use what's called the Generate Benefit Estimate tool on our website. And if you're not aware of it already, our website's www.trsga.com. And you register your account if you haven't already. And then you can go to the Generate Benefit Estimate tool, and you can play around with different assumptions on retirement dates. If you want to have your pay increases included, if you think you're going to get one, you can input it into your estimate. The computer will find your high 24 automatically. It'll show you your minimum and maximum plop amounts, your current service, how much more you'll have to your retirement date. Anticipated other service would be like a service purchase. So you may want to use estimates to see a cost benefit analysis on buying time from TRS. But a big one is anticipated sick leave service. We don't know what your sick leave is until it's reported to us by all your former and your last employer. A lot of people think we know what your sick leave is. Well, we don't. It's unknown to us until we get all that paperwork. So what you may want to do now is go ahead and get to us all the final sick leave certification forms from all your former employers. You fill out a part, you can email it. It's a signable PDF form. You fill out your part, they fill out theirs, they email it back to us, and we hold it until you're in your file until you retire. Your very last employer, you don't have to send them any kind of sick leave form. You simply check a box on the retirement application indicating that you want sick leave from your last employer, and TRS will email them and they'll email back. Unfortunately, we can't do that for all your employers, but we can for your last one. So go ahead and get that done now, and then you avoid those to do things right at the very end. Okay, now let's look at the bottom half of the estimate. This is where you see your monthly benefit and that of your beneficiaries under all the different plan options. The most the member can get is that $3,500 based on the formula. Adding or changing to option 1, where they extend the life of your bucket of money, only drops the benefit in this case by $10 a month. Option 2, your benefit drops by about $230 a month. But you can see the primary beneficiary gets the same amount of money if the member dies first. To add the pop-up to option 2 reduces the benefit by about $23 a month from that $3,273 to the $3,250. But in the event that the primary beneficiary dies first, the member's benefit would pop up from the $3,250 to the $3,500. So it would pop up $250 a month. Okay, that's how that works. Under option 3, the primary beneficiary gets 1/2 the amount. But you can see that the monthly benefit is $3,383 instead of the $3,273 under option 2. So you get more while you're both living, but then the beneficiary only gets half. Pop-up works the same way. If you want an option 4 benefit, you do have to ask for one. You can give us specific dollar amounts or a percentage, and it would create the monthly benefit for you and the beneficiary. We typically give you, just as a courtesy, a $500 a month benefit, which you see only reduces the member's benefit by $35 a month. So it's not that expensive in this case to leave a $500 a month benefit under option 4. And if you look at that middle line, that middle row, that's what the plop reduction would be per $1,000 of plop that you want to take. So let's say under maximum plan, if you wanted to leave a $10,000 or take a $10,000 plop, that would reduce your $3,500 benefit by $65.70 a month. So there's a quick read on a benefit estimate. We do recommend you get one in person, or you can also do it online through WebEx or even an old-fashioned phone call. And when you're about 2 years out or so. And, we have offices in Atlanta by Georgia Tech's campus. We also have an office in Macon, right off I-75, kind of in the north of the downtown area. So start thinking about which option is best for you and your family. Remember, you can generate your own estimates too with the Generate Benefit Estimates tool. You can get them from us when you're up to 5 years out. So let's talk about creditable service. The more of this you have, the larger your benefit's going to be. And it's broken into 3 parts, including membership. And as long as you work half the month or more, and that can be paid leave as well, you will get credit for that month. And we award service credit in 1-month increments. 9 months in our fiscal year is 1 TRS year. And our fiscal year goes from July 1 through the end of June. And if you do 9 months, unless you're Board of Regents academic faculty, you have an 8-month year, but everyone else is 9 months. And once you hit that 9 months, you have 1.0 years with us. Now, I know you're all thinking, well, I work 10, 11, or 12 months. Well, you don't get extra credit for working more than the 9 months. But if it's your high salary years, those months can be included for your high salary calculation. Okay. How much sick leave do you get? Well, you can have up to 1.25 days per month per year per your contract type. So for most of you in the classroom, 10-month contracts, you can accrue up to 12.5 days a year. If, say, you're an administrator working a 12-month year, you can accrue up to 15 days a year. So in a backdoor kind of way, if you do have a 12-month contract, you can get rewarded for that more than a 10-month contract person if you don't use any of your sick leave, because you will have accrued more. And if you don't use it over a 30-year career, I've seen people with close to a year of extra service credit because they were 12-month instead of, say, 10-month. It is awarded retroactively, which means you don't see the sick leave on your first check. It's typically there on your second one, but we do send you a separate check for any sick leave that was missed while we're doing your calculation. If sick leave records are missing, we do everything we can to project credit. We look at the records that are available and generate an average number of unused days per year based on those records, and we apply that average to the period of time for which records are missing. So you can have recorded days, estimated days, we add those together, and we get a total. These days, because of computers and how we protect data, we don't see this too often anymore. But, 30 years ago, things like floods and fires certainly had an impact on records being available. Here is the sick leave chart. There is one of these on the TRS website, also on the TRS members guide. Let me get one here for you. I do recommend that you go to the publications tab and click on members guide. It's got a wonderful coverage of all the things I'm talking about today, and also a expanded sick leave chart. I think it's on page 26 or 27. So don't feel the need to have to write all this down. But it shows you that when you have 60 to 69 days of unused sick leave, you get 3 months of extra credit. And remember, we have a 9-month year. So you're getting 3/9 of a year added, which comes out to 0.333 years added to your total. And that gets put into the formula where we take your years of service and multiply it by 2%. If you have 170 to 189 days, we give you 9 months of extra credit. So we're adding 1.0 years to your total. So if that's your scenario, you could work 29 years, have a year of sick leave, get up to 30 and retire immediately. Or you could work it the other way and have 30 years of work under your belt and add 1 year of sick leave on top of that and get a 31-year benefit from us. Because remember, you can go all the way up to 40 years, but you can't go over the 40. So, but some people even work beyond 40. They're not going to get more than 80%, but their highest years of salary come in the years after 40. So even by working more than 40, they're getting a higher benefit from us because of their growing salary. Not many people do it, but it is out there if it works best for you. Okay, let's talk about service purchases. As the name implies, this is time that you can buy and add to your total to get more from us. And there are quite a few scenarios that you can do a cost benefit analysis, and it won't take you that many years to get your money back. And for all the rest of your life, you're enjoying a richer benefit. So it may make sense for you to buy eligible time. Some of you may already have a cost calculation. You can get those updated. You're never under any obligation to buy this, but for some of these things, you may have to, invest some time and effort into completing the paperwork and getting it processed. The common ones are TRS withdrawn service and out of state. Withdrawn would be where you worked for a while and you quit. And when you quit, you withdrew the money in your bucket. Well, let's say you decide to come back to TRS covered work. Once you've been back 3 years, you can give us the money we gave you and pay us the interest while you had the money at 7.5%. That's pretty much a no-brainer. It does not take long to get your money back. So if any of you are out there today who have withdrawn service and you've been back 3 years or more, call TRS and ask for a cost calculation. And another common one is out-of-state service, where you taught at an out-of-state school. You can buy up to 10 years of out-of-state as long as you're not getting a pension from that other state. You can't double dip and get money from both states on the same set of years. So maybe you have 2 years in Alabama or a year in Texas, and you're not going to be getting anything from those states. So why not convert it to Georgia time and have it add to your total lifetime benefit? That may make a lot of sense. There's also maybe some of you worked as state employees in Georgia under ERS. I know some teachers might have worked for DFACS or something like that. That's also very cost effective. You can convert it to TRS. Maybe you taught at a private school in Georgia that was accredited. You can buy that, but that service is very expensive. If you were active duty military, you can buy up to 5 years of military if you're not going to be getting a pension from the military. You don't get credit for reserve duty, but if it was active duty, just send us your DD 214 forms. Now, there are a few others that aren't common. I'm not going to go over all of them, but again, in your members guide and on the TRS website, there's a nice discussion of service purchases. Now, if you do buy service, it's just like you worked in your TRS covered job. You might buy service to avoid an early retirement penalty. It increases your benefit 2% for each year you have. But the longer you wait, the more it's going to cost. Each year it's going up 7.5%. So it may make sense for you if you're eligible to buy it sooner than later. And one nice thing about service purchases is that you can use money in your qualified retirement plans, like your 403B. Maybe some of you have a 457 or a 401k. You can do what's called a direct rollover and move that money from that fund directly to us. You don't touch the money. It comes straight from the custodian of funds to us, like your 403B where you work. You could roll that money over to us and not have to get a loan from a bank, for example. That last point there is important. Things like out-of-state service purchases, I've seen them take 2+ years. It's not the sort of thing you can do a day before you plan to retire. If it's something you're eligible for, I would get it taken care of now rather than waiting until the last moment, because I've talked with a lot of people who had to delay their retirement because they were waiting for a service purchase to get executed. We've made life a little easier for us and for you in that we have a upload and download tool on the website. So if you're needing to send us forms or we're sending you forms, you know, you can look in your inbox for downloaded forms. And if you're sending us anything, you can use the upload tool. And that's menu driven on our website. So our last topic of the day, and then we can take questions, is beneficiaries. There's two kinds, primary and secondary. If you want someone to get a lifetime monthly benefit, you have to designate them as primaries. Secondaries don't get a monthly benefit unless it's a rare scenario. So secondaries are necessary to have. And the reason you designate them is there might be money left in your bucket when both you and the primary are deceased. If that happens, we'll give a lump sum distribution to your secondary beneficiary. So it's important that you do have at least one of each and that they're different people. But don't think that when the primary dies, the secondary starts to get a monthly benefit. It does not work that way. If you die before you get a chance to retire and you're what we call an active TRS member, that would be those who are currently working or quit, and it's within 4 years of having quit. They're still active in the TRS world. And you have less than 10 years of service, you're not vested. All we can do is refund the money in your bucket. But if you're vested, you have 10 or more years, and you die in active service, we're going to go to who you designated as primary and let them choose between option 2 and the money in your account. In a normal life expectancy, they're going to get far more in a lifetime benefit than in your bucket. But legally, we have to offer them the choice. Now, in the rare event that you pass away and there is no surviving primary, in a death in active service, we'll go to your secondary and make them the primary, and they get the choice. When might that happen? Well, probably most commonly in a car accident where you and your, say, your spouse, who's your primary beneficiary, die in the same wreck. Then we would go to whomever you designated as secondary, and we would allow that person the same choice as the primary. So you can see it's important that you have at least one of each, and they're not the same person. Now we've retired and we're getting checks and there's a death or divorce. It's death and divorce is a qualifying event for certain changes. Under certain death and divorce scenarios, you can make related changes, but you can't really do just anything you want. The law is very specific about what you can and can't do. If you have options 2 through 4 and there's only one primary and the primary dies, you can change the plan or the beneficiary, but you can't go to maximum unless you had the pop-up plan to begin with. If there's a divorce, you can change beneficiary or plan, including change back to the maximum. But if you do select a new beneficiary or a new option 2 through 4, we do recalculate your benefit and it could go down. In fact, it most likely would. So a lot of people might go with no beneficiary. Say if a spouse dies, they don't claim a new one and they go without, so that their benefit doesn't decrease. If you have multiple beneficiaries and a beneficiary dies before you, you can't change plans or remaining beneficiaries, and we don't adjust what's going to the remaining beneficiaries. So let's say you have 3 kids, you're leaving a third to each child. You retire, one of those 3 kids predeceases you. We don't change the percentages from 1/3 to 1/2. It stays at 1/3 for those 2 remaining children. If you ask me why, I'll just say that's the way the law was written. There's no pop-up for surviving beneficiaries. If you have multiple beneficiaries and you divorce, we do allow you under the law to remove the divorced spouse, and you can reallocate what was going to the spouse to the remaining beneficiaries. And we do again recalculate your benefit. So you may want to get an estimate from us before you make any official changes. Other than these kinds of events I just mentioned, you can't make changes to plan or beneficiaries. There's no voluntary or open enrollment period for beneficiary or option changes for TRS. So it's real important that you're comfortable with that choice you make before you get that first check. You know, once we mail you that first check, you're locked in contractually. You can't call us and say, gee, you know, I made an error. It's too late at that point. It's a binding contract. We have to pay the beneficiaries you've designated on our paperwork. Things like wills, divorce decrees, remarriages have no bearing on who we pay. You know, if you get a divorce and you remarry and you don't update your beneficiary and you pass away, legally TRS has to pay the spouse you divorced, and that happens 2 or 3 times every year. And it's not a fun situation, except for the divorced spouse who's getting the unexpected pension. If you want to designate minor children, that's okay. We'll just require that there be a court-appointed guardian. If you do pass away within 30 days of retiring, we do default you to option 2, regardless of the option you selected, which is nice protection for, you know, a loved one. So make sure your beneficiaries are up to date. If you have multiples, you can divide it up any way you want to, as long as when you add it up, it reaches 100%. And the other thing is, we can't pay a monthly benefit to an estate. So if your beneficiary is listed the estate of, you may want to go back in and immediately change it to the named individual. All we can pay an estate is a lump sum distribution of the money in your account. Okay. So steps you can do, you know, if you want to do a one-on-one, you can do it online or in person. When you're within 5 years, we do recommend it at 2. We can't tell you what to do, you know, give you specific advice. We're not licensed or insured to do that. It's really not part of our job function. If you want that kind of advice, you may want to look to your 403B provider that you currently use, or you may want to hire a certified financial planner or licensed financial advisor. And research shows you may be better off finding one that you simply pay a fee to, not one that works off commissions on investment recommendations. Okay. So the next step is to get excited, because you are almost there. We don't have a survey for you today, so I will stop sharing my screen. And I can, Tony, can you pick questions out of the chat box you want me to answer?
I certainly will. Let's take a look at what has been put there since you started. If the only employer, last employer, I don't understand this. Kimberly, maybe you want to unmute yourself and ask this question because I really don't understand what you wrote here. Kimberly Scott.
Good afternoon. I'm asking, maybe I've misheard it, but if your only employer is your last employer, so the time of your last year, do you still have to request a sick leave? Those forms we were told about.
Yeah, if you only had one employer, that makes it real easy because all you do on your retirement application is click a box that says, yes, I want to pursue sick leave from my last employer, and then you're done with sick leave because we'll email them and they'll email back to us and you're out of the loop. But for those of you who had multiple employers, any of the ones preceding your last employer, you're going to have to, on your own, send them that sick leave, final sick leave certification form.
Thank you.
Thank you.
Okay, Glenda Gresham, I don't understand your question either. It just says even employers outside of the school system. You want to unmute and ask your question? This was obviously in response to something that was said, and so I don't know.
Well, if it's an employer outside of TRS, you can't get credit for that unless you're talking about out of state teaching experience.
I was referring to out of state teaching experience. Like I taught in the state of Virginia.
Okay.
And left sick leave there can.
Oh.
Yes.
Good question, Pamela. Unfortunately, the law doesn't give you credit for sick leave you've earned out of state. They don't even award sick leave credit if you had it as a state employee. It doesn't move between ERS and TRS within the state of Georgia either.
Well, that's a bummer. Thank you.
Yeah.
Okay, next question. Will time off due to a workman comp injury count toward my retirement?
It may. You could look at doing a workers' comp service purchase. It's not too common, but you could start that process. You know, I would just call the 800 number. Let me give that to you. It's 800-352-0650 and just say you want to begin a workers' comp service purchase and get that ball rolling.
Okay, next question. In a scenario where you have a year of sick time accumulated, can you take that year off with sick pay and still collect retirement, or do you have to exhaust your sick time and then you start collecting TRS?
No, you don't. The unused sick leave that's been accumulated during your career is converted at the end of your career to extra credit with TRS. So it becomes part of, it gets merged with your day-to-day work credit. So you're not using it up. It gets converted to extra time worked. Does that answer your question? You get credit for that sick leave included in your very first check. And it's included as part of your benefit for the rest of your life.
Yes, it's my question. Yes, thank you.
Okay, great. Thank you.
Okay. Does the 24 months highest pay include supplements or just base pay?
It can include supplements if they're part of your contract, standard written contract. The thing to do to see if it's being included or not is your employer taking the 6% contribution amount out of that supplement and sending it to TRS? So just look at a check stub, see how much is going to TRS, and if it's 6% of your base and the supplement, then you know it's being counted as earnable compensation and would be included in the formula.
Okay, Patricia, I hope that answers your question. And I don't see any other questions. Is there anyone else that has, wait a minute, I think one just, no, she said, thank you, that answers her question. Is there anyone else who has a question for Mike? Just raise your hand or unmute yourself and ask your question. Yes, LaFrance, you have a question? LaFrance Carpenter, you want to unmute yourself and ask your question? Because we can't hear you. Okay, they're trying to unmute.
Okay, good morning. Thank you. Good afternoon. Yes, my question that I put in the chat was about the beneficiary with the lump sum or monthly. Does that depend on age? And again, I know this is pre-retirement. Do we have to select that option, or should it have been selected already?
Well, when you're hired, you need to select one primary and one secondary. And that way, if you die while you're actively working, we know who to send the money to. And then at the time you retire and you fill out your paperwork, you redesignate who you want as beneficiaries. And then we use that designation to compute your benefit. It can be the same people you picked when you were hired. And by the way, while you're working, you can change beneficiaries as often as you want. It's just after you've retired that you can't willy-nilly just change beneficiaries because you want to. Does that answer your question?
Yes, one
Okay.
part, but it's for the monthly or lump sum.
Oh, that's dependent upon what option you select. So like if you want the maximum plan or plan B option 1 when you retire and then you die right away, they'll get a lump sum distribution of any money that might be left in your bucket. All right. But if you take at retirement options 2 through 4, then your beneficiary is going to get a lifetime monthly benefit if you pass away first. So whether they get the lump sum or the monthly benefit is driven by what option you select at the time of retirement.
Oh, thank you. That was my question. So at the time of retirement, that's when I can make that designation.
Well, you're going to pick the option you want, the payout option you want. And if you take the maximum or option 1, they could get a lump sum distribution. If you decide that you want to do option 2, 3, or 4, then if you die first, those beneficiaries will get a lifetime monthly benefit. That's how that would work.
Okay, another question. How do you remove the name of a beneficiary if you divorce?
You can go online and into your account and you delete, the divorced spouse and rename someone else. And then you make sure that you click the submit button. Some people like change it, but then they don't hit the submit button and it stays the same. So you can just go online. If you don't want to do it that way, we do have beneficiary change forms. I mean, you can do it the old-fashioned way and complete a paper form, either online or mail it to us. But the quickest and easiest way is to go into your account and just physically change it, delete the divorced spouse, and put in who you want.
And for those of you who might not have been here when Lisa was presenting, please go ahead and set up your MyTRS account. Do that now. so that you will have access to all of your information and all of these forms that Mike is referencing. Go ahead and set that up now. Mike, tell me the website, the trsga.com.
Yeah, trsga.com.
Oops, I typed that wrong. trsga.com. Autocorrect did that. .com. All right, there you go. So that is what you need to do in order to set up your MyTRS account. It doesn't take long.
Nope.
Just go in, answer a few questions, and then you're done and it's set up for the rest of your employment. And when you're ready to retire, you go into that account and you do your paperwork and upload it. And you can set your appointments for a virtual or in-person interview. And it's also seamless. So please set that account up. Do that after you get off this seminar. Just go ahead and do that. It won't take you 5 or 10 minutes. That's it. And comment in the chat, very helpful website, informed if my father passed and could immediately change beneficiaries and also see annual statement. Yes, it is an extremely useful website. And also, when you go to the TRS website, trsga.com, there are videos and
podcasts,
all kinds of things that you can access. This is one of your biggest employment benefits. TRS is the #1 pension system, education pension system in the country this year. And so it's very important that you take advantage of all the information that you can get about one of your #1 employment benefits. We have a pension system that cannot be beat. There are people in private industry and in other states that envy us. Nobody else gets 2 compounded cost of living adjustments a year. Nobody else gets that. Nobody else gets a lifetime benefit. My mother died when she was 95 years old, and she received her monthly pension payment every month until I reported her as deceased. It is absolutely, positively one of the best reasons, other than the love we have for our students, to be an educator in Georgia. It really is. Mike, you always bring so much to us, and we thank you so very much for being willing to do this with us every quarter. And we hope that this has been an informative afternoon for you. If you are still actively working in the school system, I implore you to go ahead and join GAE Retired as a pre-retired subscriber. I will put the link in the chat to go to our webpage so that you can click on the link to download an application. You either have to mail it or photograph it and text it or email it to me. I've put my telephone number in the chat and my email address in the chat, and I'll do that again. If you are not a member of GAE yet, but you are an education employee, you simply go to joingae.org and you can complete that application online and become a member. And your monthly cost depends on the local dues. But remember, when you join GAE, you are a member of a national organization, a state organization, and a local organization. And benefits has its privileges. So let me put this information in the chat for you again. Let me put this information in the chat for you again. Let's see, I see a question. I was hired in July 2000 in Fulton County on a provisional while my teaching certificate was evaluated. It took until November until it was approved. TRS says I will not receive TRS benefits from July through November. How can I dispute this? You can't. The way the law is written is that there have to be contributions from the employee and the employer in order for that compensation to count. And if you want a provisional, the employer was not making contributions. So there really isn't anything you can do to dispute that. So let me put in the join GAE and the GAE retired link, and also my contact information. I am Vice President and Membership Chair of GAE Retired. I was formerly the GAE Retired President for 6 years. So my email address is ts.gae.retired@gmail.com. And my telephone number is 404 539-8660. So you can call, write, or text me. Last question. Why is the Advantage Plan the only option given? What is the advantage of having that benefit versus the other Advantage Plan? Sandra, I don't understand your question. Sandra Mead, you want to unmute and ask your question? I don't understand it.
Well, I have been trying to find my options there, and it seems like the state benefit plan gives us the only of the getting the Advantage Plan as I guess it's a supplemental for insurance, but they don't offer any other plans, and it's kind of confusing because there are other Advantage plans there, but what would the advantage be to have that plan versus commercial?
There's a big advantage. Let me explain this. Right now, you have access to state health benefits, and you will continue to have that access when you retire. And state health benefits negotiates with those companies that they offer you membership in, Blue Cross Blue Shield and United Healthcare, for plans that commercially they do not offer. I can tell you that United Healthcare does not offer the kind of benefits to the public that it offers through state health benefits plans. They pay in-network and out-of-network doctors the same. Our premiums are lower. And I have to warn you, you need to be very, very careful, because if you leave state health benefits for another plan, for a commercial plan, you can never get back into state health benefits. So I caution you, before you look at all this stuff you're getting in the mail and all this stuff you see on television about Medicare Advantage plans, I warn you, they do not match what you have available through state health benefits. And if you go with one of those plans and you're dissatisfied, you cannot go back into state health benefits. So think very carefully before you make that decision.
Okay, so I don't know if this is out of your scope, but it's just really confusing because I had somebody in my family that was an underwriter, and maybe they did not understand what the state benefit plan offered, but he said that those Advantage plans are just really lousy because it's not the same.
You're going to have to make your own decision there. I've been retired since 2013. I maintain my membership in state health benefits plans. I'm very satisfied. I'm a cancer survivor. I've had lots and lots and lots and lots of surgery. I'm very satisfied with the way I've been serviced and treated. You need to talk to other people who are with state health benefits plans. I give you this final warning. If you leave state health benefits plan, you can never get back in. You can never get back in.
Well, thank you very much for your response. I appreciate it.
You're very welcome. All right, people, that's the end of our time together today. We hope this has been helpful. You will get a link to the recording in about a week or two. We will have another pre-retirement seminar. I believe it's in April. So join us again. There'll be more to learn. Thank you so much for being with us, and have a wonderful rest of your Saturday.
Thank you so much.
You're welcome.
Thank you. I appreciate it.
You're welcome.
Thank you.
Very informative.
Thank you very much.